disappointing report.
A disappointing report indeed. And like you said, I mean, you have the inflation figures in there. You take a look at two-year yields right now, currently moving higher in the wake of that report. But we'll put this forward, and let's talk about next week, because we do get CPI next week. Of course, it is really intimately linked to how people actually feel about this economy. What are we expecting to see?
Well, the forecast is the CPI will drop a little bit. Not a lot, but resuming a trend downward. That's what that is hoping. Economists see it that way. You look at the Michigan numbers, and it's interesting because what we've done here is offset the year for the University of Michigan numbers and CPI, so that what they were looking at consumers a year ago is not necessarily what is happening today. Consumers don't seem a very good ability in recent years to predict inflation. So that's the one good note about this for the Fed is people think inflation is going to go up. Maybe it isn't.
Maybe it isn't. Bloomberg's Mike McKee, thank you so much. And as Mike mentioned, we'll be speaking live with Joanne Shu. She is University of Minnesota Surveys of Consumer Director right now for some instant analysis. You can find that on LiveGo on your terminal. But turning to the markets on this program, let's welcome in Kim Forrest. She is Boca Capital CIO and founder. And Kim, let's talk about earnings season. I think about 87% of S&P 500 market cap has reported at this point, and it's pretty punishing. I mean, you take a look at the companies that have managed to beat expectations, it feels like they're not necessarily getting rewarded as much as they might have been maybe a couple quarters ago. And if you missed expectations, well, good luck.
Absolutely. Well, you know, whenever I try to describe my job, and it's so crazy, we all look forward to earnings season, and we have to admit that we don't really care about what happened in the last quarter. Like, we only care about what happened in the last quarter as to it informs what's going to happen in the future. And I think, especially looking at ARM and, you know, oh gosh, Shopify and some of those, you know, they had pretty good earnings, and then they were killed, right? And I think we always have to remember that today's data, and that could be, you know, the data that we just got, informs what we think the future is going to hold. And investors who put their money to work, their ideas attached to money, so we really think about what we do, but whenever we pull the trigger, you know, we put that to work and make the future happen.
Well, let's talk about what the future could look like. I mean, like you said, we just got some data just now. It speaks to consumer sentiment and how people expect inflation will develop going forward. It doesn't look too good. When you marry that together with what we've heard from companies, the guidance that was given, I mean, what future is corporate America painting right now?
Well, I think they're painting a low ball picture, which is, even in good times, what they kind of have to do. There are rules and laws. The SEC makes them give reasonable expectations, and nobody likes to be punched in the gut with really bad misses. So companies have every incentive to give us lower guidance than what their sales teams might be thinking. So we'll put it that way. But again, with a sour consumer, and I think everybody's sour now, if you go to the grocery store, it's one of the most shocking experiences I've had in a very long time is to check out with like normal groceries and say, I paid what for that? I mean, we're all having that shock. And it may not be going across everything that we buy, but housing prices, if you're a homeowner, you look at what your neighbor just sold his house for, and you kind of like it and hate it all at the same time. And of course, groceries and gas. These are things we buy every day, and they're way more than people expect. And that's the problem.
It's an important point. I mean, like you said, shopping at the grocery store recently, it's a humbling experience. And with that being said, I mean, is it safe to say that we've reached the limits of pricing power that, you know, the consumer at this point just won't accept anymore?
I think so, and we're seeing that in weird places like snack foods, right? People are just not buying them quite as much. We saw that in Pepsi's earnings that the volumes are down. And I think we can expect that in a lot of areas that are discretionary spending. So, you know, companies beware, but for their companies don't really want to raise the prices like this either. They know it's going to kill their results. So it's a tough time for everybody.
It's a tough time, and I mean, you sort of touched on this. It's strange where you're finding the pockets of strength. For example, I see Sweetgreen right now. It's up, what, 40%? They're known for very expensive salads. You have the likes of Freshpet. I believe it was last week also managing to post up some big numbers, even though they're known for expensive pet food. So, I mean, how do you wrap this all into a portfolio? How do you pick and choose your spots in this strange environment right now?
Well, first of all, I have to say, most people, even professionals like myself, are really lousy about accurately predicting the short-term future. So let's do this. Let's extend out our timeline. And there are things that we know. We know that people want to buy houses. Millennials and the next generation want to grow up and have families. And these things are going to happen. But it's 3 to 5 years in the future or beyond. AI is going to be a thing, but it's not going to play out immediately like everybody expects. Again, so you have to have patience and a longer timeline, and I think that would serve all investors well.
And when we talk about AI, of course, it feels like that's the two things we talk about, of course, are the housing market and AI, and in addition to how expensive everything is. It's been striking just watching how much money is going to be spent on AI when you take a look at some of these tech companies. And I'm wondering what signal you take from that. When you see, in Apple and Amazon, whoever you want to name it, just really talk about big CapEx that they're going to be spending on AI, how do you view that?
Well, as somebody who was actually a software developer at AI companies in the 90s, I know that it's very expensive, very time-consuming, and an art to create AI technology. So those numbers reflect those realities. What investors don't really understand is what they should be looking for is not the build out of AI, which is interesting, but the longer term, who's going to use and develop AI that people find worthy to buy. So for Meta and maybe for Amazon, AI is probably going to use to market things better. And I think we all know we can probably be manipulated by machines a little bit more effectively for the companies that use it. So, I mean, I'm being kind of sarcastic here, but they're probably going to benefit. But a company like Microsoft, too, can help its clients become more productive. And those kind of uses are things that I'm looking for that are kind of right now under the radar. But AI, not just generative AI, but all forms of AI are going to help companies become more productive.
Well, you make an interesting point that, it's worth extending your timeline here, thinking about which companies, which types of businesses will be the users of AI. Because if you think about the stage of the investment cycle that we're in when it comes to AI, it still feels like people are really going after the picks and shovels, the companies that are powering AI, such as NVIDIA. But it sounds like you're saying, look beyond that.
Absolutely. And again, this is going to, I don't know that anything really pops up. I'll be honest. Microsoft's probably the only place that I think that they have a whole lot of data that they can provide better services for their clients to mine, right? Like, that's a no-brainer. But there are going to be other kind of quirkier things that we're going to go, oh, I should have thought of that. And I think to be on the lookout about where people have a lot of data, or that there's a lot of kind of wasted human activity that a machine could do better. And those are the kind of places that I'm looking for investment opportunities, and I think everybody should.
All right. Be on the lookout. Be creative. Kim, have a great weekend. Really love talking to you. That, of course, is Kim Forrest of Boca Capital. And let's take a look at what's moving underneath the markets right now. We're going to do that with Bloomberg's Bailey Lipschultz sitting to my left. And Bailey, we're going to talk about AI.
Talking AI, Katie, starting with SoundHound AI, one of the, I call it the OG AI names because it was really them and C3 AI about back in January 2023, I think. Regardless, up more than 20%, beating expectations on earnings, revenue, and results showing their growth, really talking up the backlog. Management talking about how voice AI is becoming a must-have. They touted their partnerships with car makers, with restaurants, their expansion in franchises like Applebee's. So really beginning to scratch the surface, according to some analysts. It still is a really volatile stock. It did go public via SPAC, right now trading at $5.70. It did pop above $8, closer to $9 earlier this year when NVIDIA unveiled or disclosed at least their position in the company, but volatile stock has caught up a bit in that retail craze.
Yeah, and is saying all the words that people like to hear. A big day for SoundHound AI. Kim and I were just talking about expensive salads. Sweet green, holy moly.
Big beat, Katie. Comp sales beating expectations. You know I love to take the holistic view. Actually up 20% from their IPO. Still hasn't touched near the level that it opened in that debut back in 2021, but up 40%, back at a 32 handle. Katie, the thing that stood out to me, CEO on the call talking about their automated stores, faster throughput, better order accuracy, portioning consistency, so whether or not you want those extra scoops, but basically saying that they plan to open 7 new locations and retrofit 3 or 4 urban stores, starting with one here in New York City. So you may be having a robot make your salad at Sweetgreen.
I would actually love to do like a taste test robot versus actual human. I think that would be a lot of fun. But in any case, Sweetgreen absolutely soaring right now. Of course, it's not all good news, so let's talk about Yelp.
Yeah, missing expectations, talking down guidance, full year adjusted EBITDA below what Wall Street was looking for, as was second quarter adjusted EBITDA and second quarter guidance for net revenue. Stock relatively flat today, though, so not really a big move. This is a company that is dealing with macroeconomic uncertainty. Also, competition concerns is one of the things analysts really called out, whether or not you need to leave a review on a Yelp if you're using, say, TikTok to tell you where to go, or if you're using things like ChatGPT or various AI companies sticking to the AI theme to tell you which restaurants to go to. Maybe you're not leaning on Yelp as much, but regardless, not really much of a drawdown for the stock today.
Yeah, not too bad, all things considered. Yelp currently down about 0.2%. Bloomberg's Bailey Lipschultz, have a great weekend. Now coming up, Novavax soars after signing a $1 billion licensing deal with Sanofi. Emily Field of Barclays says that the timing of the transaction raises some questions. She joins us next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Well, shares of Novavax are absolutely surging today after it signed a deal with French drug maker Sanofi. This is a $1.2 billion licensing agreement. It includes commercializing a combined COVID and flu shot. Joining us now is Emily Field. She is Barclays Head of European Pharmaceutical Research. She has an overweight rating on Sanofi. Let's talk about this a little bit, because actually yesterday on the program we were talking about Moderna, which I know you don't cover, but about how Moderna needs to diversify away from COVID-19. You have uptake really falling off. And then we have this deal today. Tell me about what you make of the timing.
Yeah, and thanks for having me. I would say that's been investors' number one question today as well. Why and why now? Because also just yesterday we saw that AstraZeneca is going to basically stop marketing their own COVID-19 vaccine. So I think the timing was certainly the biggest question. And the message from Sanofi is that this is really about future combination with their flu vaccine. They're the market leader in high-dose flu vaccine, and it's a €3 billion business for them annually.
Interesting. So, I mean, timing aside, I mean, talk us through the logic. Do you think that this deal still makes sense?
Yeah, great question. I mean, I think that Sanofi's strategy, and we did speak to the head of their vaccines business this morning as well, seems to be, just building as big a moat as possible around that leadership in flu vaccine. Because as we're seeing with mRNA, Moderna, other mRNA competitors are trying to encroach outside of COVID. We may see an update in RSV later this month, which also has some news this morning. But all the mRNA players are going after flu. So as is Sanofi, they have a program there as well. So I think that what Sanofi is trying to do is just have as many options available to partner with their incumbent business to maintain that leadership.
And what do you think they see in Novavax necessarily? I mean, it's a relatively small company, U.S.-based. What do you make of this particular partner?
Yeah, so I think that why the logic for this deal made sense for Sanofi is that, their flu vaccines use more of a traditional modality, and an adjuvant technology is the Novavax technology for their COVID vaccine, as opposed to the Pfizer-BioNTech and the Moderna's, which are an mRNA. So I think that as it's still an unanswered question, how big are mRNA vaccines going to be outside of a pandemic environment? Clearly, all signs point to a big decline for COVID as we see it today. I think that Sanofi wanted a traditional mechanism, COVID vaccine, to partner with their traditional flu vaccine to have that as a defense against potential mRNA competition.
I'm also curious to hear your thoughts on the price tag here, because $1.2 billion, it's not nothing, but it's not enormous. And it's interesting. Usually in M&A, you see the acquirer, their shares fall, but it seems like traders aren't too fussed about this.
Yeah, I think in the context of Sanofi, $500 million cash up front, the extra $700 million would be tied to milestones. It's a relatively small upfront transaction. We tend to take a lot more notice from a financial perspective when there's a B at the beginning of the transaction figure. So I think for Sanofi investors, of course, questions on timing, but is it financially all that material? Not really. It's a much bigger deal, I think, to Novavax investors.
And I feel like, of course, what's going on in the shares of Sanofi is kind of an afterthought, because shares of Novavax, holy moly, I mean, they were up more than 200% pre-market. They're still higher by about 100%. What do you make of that? Because it feels a little funky.
Yeah, that was one of the first things that we looked at was what's the short interest in Novavax, and I believe it was over 30% of the shares were sold short. So I think that the short covering is probably driving a lot of the price action there today. But you're absolutely right. From a Sanofi perspective, not that big of a needle mover. There's a lot more going on with Sanofi that investors are cognizant of.
And just talk to us about Sanofi in the context, of course, of the European market and the competitive landscape there. Again, $1.2 billion, not nothing, but not huge. But where do they rest currently right now? What does it look like?
Yeah, so I think for Sanofi, what investors are most focused on is their immunology business. Their biggest selling drug, Dupixent, is an absolute blockbuster. We're awaiting approval later this summer for a potential approval in COPD, another respiratory disease. It's already approved in asthma. So that's going to be their growth driver through the end of this decade. And then, of course, what will be the primary thing that investors are looking for in the years ahead is how is their pipeline going to mature. They had a big R&D event last December, a lot of programs moving into phase 3, and so we'll get those readouts in the coming quarters and years.
All right, Emily, really appreciate you hopping on, and of course appreciate your insight on this breaking news. That is Emily Field of Barclays. Meanwhile, we want to bring you some other breaking news, and that is that Zeekr shares, they're indicated to open, they're indicated at $23 to $25. The IPO price had been $21, so a bit of a pop there. Of course, Zeekr is a Chinese EV company. It's owned by Geely. It's going public today, and just bring you that headline once more. Zeekr shares indicated at $23 to $25. Remember, the IPO price had been $21, so definitely a premium there. We'll continue to follow that one and bring you more details as we have them. But still ahead, we're going to look at the companies making the most social buzz today in our Social Climber segment up next. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
It's time now for Social Climbers. Look at the stocks making waves on social media this morning. And first up, Apple reboots. It's pulling an ad for the new iPad Pro, which drew heat on social media. The ad, of course, it shows a giant machine slowly crushing a palette of creative tools like instruments, paints, and books before it reveals the new iPad. But critics slam the ad, saying it promotes, quote, the destruction of the human experience. Apple has apologized, saying it, quote, missed the mark and the ad will no longer appear on TV. Again, I didn't think it was that bad, but Apple didn't quite ask me. Next up, OpenAI, set to reveal its rival to Google on Monday, according to Reuters reports. Sources have told Bloomberg the company has been working on a search engine feature for ChatGPT, which can search the web and cite sources and results. Google's parent company Alphabet dipping slightly on the news. Finally, we have shares of Planet Fitness flexing after the gym chain announced it will raise prices for the first time in 26 years. The company, of course, had a lackluster report on Thursday, lowering revenue and profit projections, but its plans to increase the price of a classic membership to $15 a month from $10. It stopped investors from breaking a sweat. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Let's take a quick check of these markets because, again, we have a green day on our hands. You can see the S&P 500 up slightly, 0.2%. Big tech, same sort of deal. Meanwhile, you take a look at the SOX index, still up by more than 1%, but some of those gains have come in about an hour or so into trading. Now coming up, we're going to speak to Greg Abel. He is OnBridge CEO and President next. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Well, energy giant Enbridge out with earnings, and it's a beat. Bloomberg's Abigail Doolittle has more.
And the stock responding well, Katie, up about 1% on the day, and it was a beat relative to adjusted diluted earnings coming in at 92 cents versus the estimate of 82 cents, so a pretty solid beat there. Free cash flow, or cash flow, I should say, that can be distributed also beat. And then they are on track to achieve their full year EBITDA and DCF per share guidance. So all good stuff here. Now, of course, if we take a look at the pipeline revenue, we're going to see tremendous growth here. For the first quarter in 2024, they put up $6.8 billion in liquid pipelines revenue. That is not double fourth quarter, but you can see just massive growth here after a few quarters, many quarters in the roughly $3 billion range. So really, actually, it is basically a double. So very, very impressive performance there. As for year-to-date stock performance, the stock is up about 5%, kind of in line with some of the other players in this space. Not quite as high as Williams, but nonetheless, a good year and great quarter for Enbridge, Katie.
All right, Bloomberg's Abigail Doolittle, thank you so much. And let's keep this conversation going because joining us now, we have Greg Ebel. He is Enbridge's president and CEO. And let's first start with that revenue because that chart that Abigail showed was particularly dramatic. Of course, a doubling there. What drove that, quite simply?
Well, really, full utilization of our pipelines. I will say the revenue number is always a bit unique because it's got changes in the price of commodities, right? So if the liquids products go up in the price, you see that flow on the revenue line. So the real focus from our perspective is utilization of the pipelines right across our entire system, utilization of our gas pipelines, the power business, et cetera. And basically, our EBITDA was up 11% year on year, which really, Katie, speaks to just how important energy is, all forms of it, and it looks like we're going to continue to see a big move forward on the use of power and the use of gas and liquids and renewables. I mean, it's all of the above strategy, which the industry's been talking about for a long term, but I think you're starting to see it come through in the macro results as well.
Let's talk about the industry a little bit more and gas flows in particular, because it feels like there's more volatility ahead. You think about LNG, renewables, weather, maybe data center demand, which we're going to get into. What are you seeing, and what are your views when it comes to natural gas storage right now?
So when I think about our big gas pipelines this year, whether it's from the Gulf Coast up to the Northeast or whether it's along the West Coast of Canada, et cetera, we're seeing really peak days on all those pipes. So that tells me that as you get up to, like if I look on our West Coast pipes, 99 of our last 100 peak days occurred just in the last year or so. So that means that there's going to be a need for more pipelines, more capabilities to be able to bring gas to demand markets. And why is that? You know, the price of producing gas in the field, maybe say $2, if you will, but a price in, say, New York City, where you are, people will be paying often double-digit prices. The only reason that is the infrastructure needed to get into New York City, for example, or Boston. So it says to us there's a bigger demand for pipelines out there. You mentioned storage. We see that volatility storage is driven that. So think about it, depending on where it is, it's like having a big thermos bottle full of gas, and when you need it, you call upon it. And that's usually when there's volatility in weather, volatility between regions. And we've really seen an increase in storage prices for our customers and the length of time they want to buy it. So again, I really think it speaks to the critical need for energy infrastructure and gas in particular. There isn't really a very bright future globally or in the United States and Canada without having a strong gas backbone.
Well, you mentioned, of course, New York, you mentioned Boston, but let's go down to the Permian, because I'm really interested in what you see there, what your expectations are when it comes to oil and gas growth in that region.
Yeah, right on. So if you think about the Permian, we have a great position there on the liquid side. We pull, all the major pipelines coming out of the Permian bring oil down to Corpus Christi. We're the largest exporter of crude oil out of the United States. Or do they go to the east of there to the Gulf Coast refinery complex in and around Houston? So on the liquid side, that continues to grow. And we just announced building some more storage at our facility, our export facility there, and expanding some pipelines back in the Permian. On the gas side, the same thing. Just in this last quarter, we announced a new joint venture that would see us have more access to the Permian with gas pipelines there. We have a new open season or marketing effort, if you will, to build another pipe into the Permian. And now we're able to, at the joint venture, to serve all of the LNG export facilities, which, as you know, the United States has gone from nowhere on that front 10 years ago to now being the largest exporter of natural gas. And we're just pleased we can serve our customers by being attached to all of those on the Gulf Coast.
Yeah, really dramatic changing of the guard there. I'm not sure how many people expected that one, but I want to talk about another pipeline as well, the Trans Mountain Pipeline, TMX as it's known. It started service on May 1st, and the feeling in the industry is that it could steal volumes that are currently shipped on your pipelines. Are you modeling for a potential impact there?
Well, that's a pipeline that was expected to come into service before 2020, actually, right? So that was a concern. I think that's an old thought that we may actually lose some volumes from that front or anything significant. We continue to see record volumes on our main line, which competes against TMX. We got a better toll put in place for our customers last year so that we're more competitive from a tolling perspective. And then last but not least, but really critical, since that pipe was supposed to come in 19, 4 years later, the Canadian basin continues to grow. So our customers are actually looking for more exports. So, we expect to still ship about 3 million barrels a day on our mainline system, which is, a dramatic increase from where we were 5 years ago. And so any slight impacts we haven't seen yet, but we've actually modeled those. And that's part of the reason for a really strong first quarter is we're continuing to see, and we see that in demand from our customers, even into May as TMX has come on, that we're actually in apportionment, meaning there's not enough space on our pipeline for all our customers for the amount they want to use it.
And you know that I have to ask you about data centers as well. Of course, it was a topic on the earnings call, and you said that Enbridge, it's well positioned to cover data center demand, but that demand, it takes some time to ramp up. And I guess to start, just lay out through that, how data center demand works its way into your business. Where do you see that relationship, that daisy chain actually taking place?
For sure. You're bang on, Katie. A lot of numbers out there and thoughts about what's it going to do to power demand, whether it's a 0.5% increase or a 1.5% increase a year through 2030. Not exactly sure, but what that means, any increase is going to be calling on two forms of power. One, first and foremost, gas. and our natural gas pipelines are located 50 miles or less from 47% of all the gas-fired generation in North America. So that means as that new power demand is required, they're going to need the gas, and the gas is going to go through, we've got the opportunity to come through our pipelines. They also need storage, which we talked about a little earlier. And then if you think about the Googles, and you think about the IT folks, the large tech folks, they love AT&T, for example. They love obviously having renewable element. So our renewable power opportunities are there as well. So solar and wind, and we're seeing opportunities to sign long-term contracts, 15, 20 years with some of those players on the solar side. So we really get it coming and going, both on the gas and our gas infrastructure, but also on the renewable side. So we'll see as it ramps up. There's no doubt it's going to be a bigger need for power, and generally speaking, that swing, reliable energy's got to come from gas.
Well, Greg, we'll have to stay in touch on that point, of course, as that demand from those data centers does ramp up. Really appreciate your time on this Friday morning. Our thanks to Greg Ebel of OnBridge. Meanwhile, we do want to go back to that Zeekr IPO because, of course, we have some more numbers now. It's indicated at $24 to $26, that range continuing to move higher from its IPO price, which was $21. We're still awaiting for the shares to start trading. And remember, this is the biggest U.S. IPO by a Chinese-based company in 3 years, and it's an EV maker as well. So a lot of lines there to keep track on. But let's get a check on these markets, and we're going to do that with Bloomberg's Abigail Doolittle.
For the week, Katie, we're looking at a pretty risk-on tone. We have the S&P 500 up 1.8%, up for a third week in a row, the longest weekly winning streak since February. The Bloomberg Dollar Index up just a little bit. Oil, a risk asset, also higher. And then the 10-year yield, those Haven bonds, there's a little bit of a bid there. So that's not necessarily confirming the risk-on tone, but I would say it's a small enough move that overall, again, investors are relatively bullish right now. Now, if we switch up our board here, we are going to see that the Dow, I know we don't usually talk about the Dow, but this is an 8-day board chart of the Dow, and the Dow Jones Industrial Average has been up 8 days in a row. That's the longest winning streak going back to December of last year. So it's interesting to see this strength for the more narrow blue chip type company index there, Katie. As for the S&P 500, well, earnings season for the most part is over, and this is really interesting because, of course, coming into earnings season, stocks had been near record highs, then down, and now this 3-week winning streak. Overall, though, for this earnings season, this is what the S&P 500 has done, up about 0.3% relative to some of the other past earnings seasons that we've had, especially the fourth quarter earnings season when stocks rose 4.6%, really doing a whole lot of nothing, but there was a lot of volatility in that nothing.
All right, Bloomberg's Abigail Doolittle, thank you so much. Now, coming up, we're going to hear from Jenny Johnson, President and CEO of Franklin Templeton. She joins Wall Street Week on why companies are choosing to stay private for longer. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time We have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
This is Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
All right, it's time now for our daily Wall Street Week conversation. And Wall Street Week host David Weston spoke with Jenny Johnson, the president and CEO of Franklin Templeton, at the Milken Institute Global Conference in Los Angeles. They talked about the firm's growth and where it's seeing opportunities.
We're now a $1.6 trillion asset manager. What hasn't changed is we've been very global for a long time. We have clients in 160 countries, but we used to be just traditional asset management. Now we're half institutional, half wealth channel, and we are a top 10 alternatives manager. So we've got, secondary private equity, real estate, private credit, venture. So we've had to evolve as the business has evolved.
You had a strong background in mutual funds. How much of your business is still in mutual funds?
Still a significant portion in mutual funds. I would say it's probably 900 billion of the 1.6 trillion is mutual funds, maybe even a little bit more than that.
And tell us about alternatives. I mean, there's a lot of talk about private credit. By the way, real estate as well. Where particularly are you in alternatives right now?
So one, private credit, we have about 78 billion in private credit. And it's interesting because a lot of people worry about the growth in private credit, but I think what they miss is banks are just, the capital requirements around banks has changed so much that they're not lending like they used to. And so really that's shifted into the private credit market. And today, if you could withstand the illiquidity nature of the investment, high yield, you can maybe get 7.5%, 8%. Private credit, you can get 12%. That's a big difference in returns. It's just that you're not going to be able to get your money back for, 5+ years, probably.
One of the things that's said about a lot of private credit is a maturity match. So basically, you have access to the capital for a period of time, unlike, for example, a traditional bank, which is deposit-oriented. What is your maturity match like?
Well, when you raise a fund, you tell your fund holders, look, this is probably the length of this fund. And so you really try to match it to that. So I think it's just setting expectations. In some ways, it can be harder for a bank because their depositors, as you saw with SVB, right, where 40% of their deposits outflowed in an hour, that's a different thing. In the case of the private credit market, in many ways, it's a better match because they raise the fund and they set expectations at the time you make your investment.
Why do you think private credit is growing the way it is? I mean, initially, I think it was the thought of we need higher returns when basically interest rates were approaching zero, and you could tie assets up and get larger returns. Those days are gone now. We're back up to reasonable interest rates.
I think it's two things. I think the growth in private equity, and that's a whole other thing. I think companies are waiting longer to go public. I don't think this is necessarily a good thing. We have half the number of public equity companies that we did a decade ago and 5 times the number of private equity-backed companies. And oftentimes there needs to be debt instruments as those companies are going private or, so there's lending in the private equity acquisition. They want a piece of debt. So that's grown in the private credit. And then, as I mentioned, The capital requirements for banks have been such that it's really hard for banks to lend in the same way that they used to lend. And so they're preserving their capital for just lending to their very best customers. And honestly, the rest are kind of filled in by the private credit market. And you see it post Silicon Valley Bank, where regional banks were the big lenders in real estate. They've now dried up, and so now it's the private credit market that's filling in to do the real estate lending.
Talk a little bit more about the private equity situation. You said it takes longer now than it did before to go public, to have an IPO. Yeah. So it's harder for people who put the money in to get the money out. How is that playing out?
Well, so two different things. So one is, I think companies are choosing to stay private for longer because of, honestly, some of the nature of being a public company. Pressure on quarterly earnings, this kind of short-term mentality around quarterly earnings. In the past, if you went public partly because you needed to monetize some of your original investors. Now there's a private equity firm that can take out those investors. So a lot of the transactions were done private equity to private equity. So companies can just stay private longer. And in a time like now, where you have great technological innovation going on, and the work that Franklin Templeton's doing in AI and blockchain probably isn't going to pay off for a few years. If you're a public company, it can be hard to make those investments. We still have founders that own a big chunk of stock, so that gives us a little ability to act a little bit more like a private company. But you're going to invest in these things that aren't going to pay off for a couple of years, and that can be hard when people are looking at, are you beating your numbers this quarter? So I think that's a bit of a challenge, and I think that there's just a variety of reasons. People are, with the luxury of staying private, CEOs are choosing to stay private longer. In 2000, the average company went public after 3 years. Now it's anywhere from 9 to 15 years. And 2 times the growth appreciation that used to happen post-IPO is now happening in the private markets.
Well, tell us more about innovation and how it's affecting Franklin Templeton. And let me pick out one thing specific, tokenization. You were early in on tokenization. Tell us where you're using it, how you're using it, why it works.
So first of all, I am a huge fan of blockchain and the technology. And we had the first SEC-approved money market fund, a 40 Act mutual fund. The SEC had us run the shareholder servicing system. We used to run our own in-house. We're one of the few firms that did. And the one that we built on blockchain. So these are the records of the shareholders. And we parallel processed for a period of 6 to 8 months. And we were astonished by how much less costly it was to run it on blockchain. It's a very efficient technology. And we think it's going to open up a lot new investment opportunities. And honestly, eventually, I think ETFs and mutual funds are all going to be on blockchain.
And that was Jenny Johnson. She is the president and CEO of Franklin Templeton, and of course, Wall Street Week host David Weston. And tonight on Wall Street Week, we'll hear from Mark Rowan, Apollo Global Management CEO, and Barry Sternlicht. He is Starwood chairman and CEO. That's at 6 p.m. New York time. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Uranium ETFs, they continue to climb this year. They've grown to $5 billion in assets compared to just $150 million 3 years ago. Joining us now on this ETF Friday is Eric Balchunas. He is Senior ETF Analyst over at Bloomberg Intelligence. So what's going on with uranium? What's behind the boom?
Yeah, no, we call it green investing for realists. We think a lot of people, if you look at trying to get to net zero, if you look at where we're going to get electricity from, people don't want to stop moving around. So nobody really wants to give up anything. So nuclear is probably going to have to be part of the solution. And so there's obviously some stigma attached to nuclear. People are a little bit afraid of it, but we feel like that tide is turning a little bit. And so they just announced they're going to open a new plant or a plant that had been decommissioned in Michigan. And that's in the U.S. And they've been doing some things in Europe and China. And so there's all these good catalysts that are coming out in terms of the sentiment and the actual dollars going towards nuclear. So the uranium ETFs are the benefactor of that. And I remember when they came out, I was shocked because they launched one after the end of a 10-year bear market. But they had so much room to run. They've gone up a ton in about 5 years, and their assets have grown about 30-fold. And they're at $5 billion. We predict they'll go to $10 billion by the end of next year, which would make them by far the biggest clean energy ETFs in the world.
There you go. Flows following performance here and perhaps chasing some of those tailwinds that you mentioned in terms of the what's going on with nuclear, et cetera. I have to admit, I don't often think about uranium ETFs. You know well, I think about a lot, but not uranium. What does the competitive landscape look like in uranium ETFs? Who's the big dog here?
Yeah, look, all these ETFs are what we would call hot sauce. They're probably used in small allocations on top of a more vanilla core. But URA is the more conservative brand of this hot sauce. It has more utility companies and it's has more beta in it. URNM is really more of a pure play just on the miners. So it's going to be jumpier. And then they even have one called URNJ, which is the junior miners. And that's the jumpiest. So people, have to kind of decide how much volatility they can handle. The more volatility, the more potential upside, but also the more potential downside. So that's sort of the landscape. Most categories are the same. You got really looking at standard deviation to me is an underrated field when you're picking one of these thematic ETFs. How much can you handle?
How much can you handle? Well, it'll be fascinating to see, of course, with all of this growth and, of course, the good performance numbers, whether we see more launches in this area. But we're going to have to put a pin in that conversation. For now, our thanks to Eric Balchunas of Bloomberg Intelligence. And be sure to tune in to me and Eric every Monday on ETF IQ at 12 p.m. Eastern. It's a great show, if I do say so myself. Let's take a quick check on these markets. Right now, the S&P 500 hanging on to gains, but it looks like we just dropped into unchanged territory. Of course, we're still higher on the week when you take a look at how the past several days have gone, but still looks like the Friday momentum is starting to fade. You take a look at the NASDAQ 100, same sort of story. I'm going to go ahead and call that unchanged. Again, another up week expected for that benchmark, but gains fading right now. The semiconductor index holding on, up 0.7%, but we were about 1% higher about an hour ago. Now coming up, we have the Grindr CEO. He joins Bloomberg Technology next, but that does it for Bloomberg Markets. Have a great Friday. I'm Katie Greifeld, and this is Bloomberg.
in recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde in San Francisco. Ed Ludlow, he's off. This is Bloomberg Technology. Coming up, the US set to unveil sweeping tariffs on China, targeting EVs, batteries, and more. Details ahead. Plus, we'll sit down with the CEOs of Grindr of Akamai to break down their latest earnings results. And Apple apologizing for its latest ad after online backlash. We'll discuss that and so much more throughout this hour. First, let's get a quick check on these markets. And look, it is 3 straight weeks of gains, folks. That is the best winning streak we've seen since back in February. But on the day, we're actually just pulling back a little. Look, only 0.2% on the NASDAQ. Some mixed economic data coming through. In particular, some of the confidence, consumer confidence, actually falling quite significantly in the previous month. That because of lingering inflationary issues, labor side concerns. But nevertheless, we're down some 0.2%. But the SOX 600 over in Europe on a tear are up 0.8%. And in fact, we have just a real run of good gains in Europe as we see earnings beat time after time. Every single industry group up to finish the day over in Europe. Bitcoin echoing some of that slight risk aversion, but notably we're also seeing, well, the first time you're seeing crypto exchange volume actually falling in about 7 months. So post-Bitcoin ETF, slight pullback. Slight reality bump. We're off by 2.6%. Move on, have a look at some of the individual movers that we're looking on the micro perspective. And Warner Brothers Discovery, actually your best performer when you're looking at the NASDAQ 100. Up more than 3% yesterday. Lucas Shaw breaking the news that David Zaslav is looking to control costs here once again. Maybe even more job cuts to come. Remember, they've already fired some 2,000 people. We could see a real focus on ultimately profitability at the moment for Warner Brothers Discovery. We're seeing actually Apple off by more than a percentage point. Look, we'll get into the woes that is the pulling of the ad when it comes to the iPad, that seemingly crushing of ingenuity and human expression. Certainly not being liked. Apple apologizes, but we're down a percentage point. Tesla also down 2.3%. Earlier it had been trading higher. Now, is this something to do with the fact that now we've got a flip reverse on what Elon Musk is currently doing with superchargers? Yes, he is going to be focusing on some $500 million of investment in that area. Swift reversal from what we'd heard the previous week, the fact that he was, of course, firing the entire team of the superchargers. But also, is this more to do with geopolitics? Is this more to do with the fact that the Biden administration is potentially set to unveil a sweeping decision on China tariffs next week, targeting key industries, including, well, for Tesla's perspective, electric vehicles and batteries and solar cells? Would that mean we get Chinese backlash on US producers such as Tesla? Joining us for more, Bloomberg's Mike Shepard, who's in Washington. And Mike, incredible reporting coming from the team at Bloomberg, and it does seem that this is finally, after years of decision, more focus on China in a targeted manner.
Well, it certainly is, and I'm glad you brought it up in that context. The team did such a terrific job really going after this for weeks and weeks to try to figure out when and in what manner this decision would take place and how it would hit. And it is really shaping up in those three areas that you outlined. This is going to be one of the most significant moves that Biden has made since taking office with respect to China. It is one of the most consequential because it affects that big round of tariffs that Donald Trump announced back in 2018, and that has been the subject of a lot of back and forth with the world's second largest economy since then.
Therefore, are we expecting more back and forth? Are we bracing ourselves for the fact that if this does indeed target more of the EVs, the solar, and indeed we've already seen some focus on metals, even though that didn't have a broad implication, are we going to have more tit for tat here? Is China going to respond?
Well, China responded this morning, at least with a verbal volley, objecting to this. You'll recall that, with the emergence of news about the export controls aimed against Huawei, that they saw that as economic coercion. They're complaining about this as well. The response to the news last night was swift from the Chinese government. They're concerned. However, the retaliation from China may not come in the areas that directly align with the policy that we're seeing and will expect next week. Senator Chuck Grassley, according to our reporting, is indicating that we may see a retaliation in agricultural products, trying to hit America where it hurts, but in a different place. And it's something that in the past has been targeted by Beijing.
Just stay with us, Mike. We've got some breaking news. This being reported by the Wall Street Journal, so building on the Bloomberg reporting that apparently the Biden administration is actually going to quadruple tariffs on Chinese EVs. Now, how broader implication is that, considering not many electric vehicles are actually shipped from China to the United States?
Well, you're right. And the whole idea of this, at least with EVs, is it's symbolic in a way. It's low cost for the Biden administration to quadruple EVs because there is no consumer impact at home. Remember, when you raise tariffs, it is not the country that is targeted with the tariffs that pays the cost. It is actually the consumers in the purchasing country that actually pay the price. And in this case, China does not have much of an EV market presence here in the U.S. with its makers. So the administration is trying to do two things. It's trying to show that it's tough without imposing too much cost, but it is also trying to create a bulwark so that it is harder for Chinese makers to break into the U.S. market, which is becoming increasingly amenable to the idea of EVs.
We'll see also what Europe does. We know that Europe has been focusing a lot on EVs when it comes to China as well. Mike Shepard, brilliant to have you. Thank you so much on the latest when it comes to tariffs. Now, all of this, is the context with which you're trying to invest more broadly across assets at the moment. The geopolitics is a key headwind. Let's dive into that and the impact on equities and tech in particular with Mona Mahajan. She's Senior Investment Strategist at Edward Jones. And once again, we're just, Mona, seeing more and more navigation necessary by big tech companies of geopolitics. Is that an overhang for you?
Yeah, thanks, Caroline. It's a great question. Look, I think as we get closer and closer to election time period, we will be hearing more and more about the policies that both sides of the aisle will be proposing. And a lot of times what we see is the impact is felt in an outside way in certain sectors. And technology is certainly one of them. I'd point to healthcare as another, depending on regulation and policy that's administered. Higher taxes, as was noted earlier, higher tariffs, taxes in general, does tend to be inflationary. So we have to think about that. Will the administration want to take that step? Or is this more symbolic in nature in that we don't want to, one, enter a more meaningful trade war with China, but two, we want to signal to them that they cannot be flooding the market, whether it's EVs or any other end market or good that they may be trying to get into the U.S. So keep in mind, some of it is signaling, some of it has real meaningful implications for areas like technology, but we will get more and more insight into how these policies may unfold, I think, as we get closer to the November time period. I'd say more broadly, we are looking at a market that has been driven still by the momentum behind AI and technology and mega cap technology in particular, but we do expect that to broaden over time.
And can that broadening withstand still issues? You mentioned inflationary pressure coming from tariffs. Inflationary pressure is still something that the Fed is still very focused on. We're hearing from many a Fed member at the moment saying we're going to be higher for longer. We see stocks just take a little bit of a dip on the back of that context, Mona. Are you expecting inflationary headwinds to limit some of the increase in the stock markets from here?
You know, actually, we are in the Jerome Powell camp, who he did outline, you know, he had the famous line, he doesn't see the stag and he doesn't see the inflation. We are also of the mindset that we do think inflation can gradually, perhaps not in a straight line, but gradually move more meaningfully towards that 2% target for a couple of reasons. One, we do see that shelter and rent component playing some catch up. We are seeing the data in real time. If you look at a Zillow rent index, move meaningfully lower. That has not yet showed up in any of the CPI baskets. And even the PCE basket, which is a lower part, has a lower exposure to shelter and rent, still hasn't moved meaningfully lower. So we think that's coming. Number two, we are starting to see more meaningful potential slowdown in the wage gains component of the labor market. So labor market, a couple of early signals of softening. Not only the non-farm jobs report on Friday, but also the jobless claims figure this week was elevated. We think over time there'll be better balance in the labor force, more supply coming in, less demand for jobs, which will lead to softer wage gains, which has a direct implication on services inflation. So the combination of shelter and rent and a softening labor market, we think, will lead to better inflationary trends going forward. That combined with this earnings growth picture that we are seeing continuing to outperform and improve meaningfully, we think is a good tailwind for equities broadly.
Interestingly, here in San Francisco, the one key thing that comes up time and time again is how expensive engineers are, whether it's particularly in the field of AI, software developers a little bit less, but still they're arguably about $1 million in terms of their overall pay at the moment, Mona. I'm interested in what you make therefore of AI, the tailwinds of AI more broadly. Are we going to see, when you mentioned the broadening out, which industry groups in particular, is it the healthcare industry groups that we start to pile into?
Yeah, you know, it's a great point because thus far what we've seen is most of the gains from the AI trade have been felt by the enablers of AI, the infrastructure players, the semiconductors, for example. We do think over time you will see the sectors that will benefit from the productivity gains of AI start to place a meaningful catch-up as well. And you mentioned healthcare, that's certainly one of the sectors. But if you look at financial services, if you look at manufacturing and industrials, all of those sectors we think will be beneficiaries. And this is over, you know, not a 12-month period, but probably more like a 3 to 5 year period. We will start to see those productivity gains come through. And keep in mind, those sectors are not only prevalent here in the U.S., but globally. When you think about where, you know, manufacturing, financials, industrials tend to lie, it does tend to be in non-U.S. markets as well. So we think there is a case to be made to have exposure to the U.S. We like having exposure to that mega cap technology, but also the sectors that may benefit from AI, but also international, we think still plays a meaningful part of your portfolio.
Thanks for going global with us. We love it. Mona Mahajan, great to have you on. Senior investment strategist at Edward Jones. Stay well. Happy weekend. Meanwhile, well, look, maybe not a happy weekend for some if you're looking at the infrastructure here in the US. A severe solar storm is expected this weekend, and it threatens to trigger blackouts, disrupt navigation systems, knock out high-frequency radios around the world. Now, this is the first time since January 2005 that the US Space Weather Prediction Center has actually issued a G4 geomagnetic storm watch. It's the second highest on a 5-step scale. And it says multiple waves of solar energy are going to be bearing down on the planet. Now, 5 eruptions of material from the sun's atmosphere are forecast to arrive starting late on Friday and persist through Sunday. Coming up, we'll hear from Snapchat CEO Evan Spiegelman talking all things social media as TikTok ban looms here in the United States. What did he have to say at yesterday's San Francisco tech event? Meanwhile, TSMC on an absolute tear. Let's focus in on the fact that its April sales jumped 60%. You guessed it, sustained demand for AI chips. Maybe there's a broadening out here as well, as we see perhaps a bit of a bottoming out in the global smartphone industry as well. Returning to growth for them. We're seeing it really paying out for the world's largest contract chip maker. This is Bloomberg Technology.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Time now for Talking Tech. First up, Elon Musk's U-turn on superchargers. Now, the Tesla founder says that the company will still spend well over $500 million to grow its charging network this year. Now, the news comes just over a week when Tesla actually fired nearly roughly 500 people who were running the charging business. Plus, for years now, SoftBank has quietly sold off billions of dollars of assets from its flagship Vision Fund. Now, a sign that basically founder Masayoshi Son is shifting away from broader venture capital deals towards investments in just semiconductors and AI. Now, since the end of 2021, SoftBank's Vision Fund saw its US portfolio shrink by almost $29 billion. And Microsoft enters the mobile gaming arena, announcing it will launch its own version of a mobile game store by July, taking on the likes of Apple and Google. Now, the browser-based store will debut Microsoft's own games and offer discounts on in-game items. Microsoft says that eventually it will open the store to other publishers at a later date. Let's turn from gaming to social. And Snap CEO Evan Spiegel is urging the government to develop a more comprehensive framework for dealing with national security issues. So after social media rival TikTok faces a divestment or ban ultimatum. Now, here's part of what he had to say at Bloomberg's technology event in San Francisco.
Always focused on communication between family and friends and making that really fast and fun and visual. And I think that's why we've been able to continue to grow through all the changes that you mentioned to now reach more than 800 million people. So, I think just sticking, really staying focused on those close relationships. They're the relationships that mean the most to us. They're the people we talk to most frequently. And enriching that, through Snapchat with visual communication, with stories, with the map that allows people to see what their friends are up to, where they are, what they're doing. All these sorts of products, I think, help bring people closer together with the people that mean the most to them. And I think that's really what's, led to our just enduring growth.
We actually have a poll, a TikTok-specific poll. What is your opinion on the TikTok ban? I'll be bummed when TikTok is banned. TikTok should be totally banned. I don't care either way. So please vote. Are you a TikTok should be totally banned kind of guy? Like, that seems like it would be an opportunity for you.
It's probably a no-brainer.
But really.
What I think is really important is that we come up with a durable framework to deal with these sorts of national security issues. I think the United States has recognized that there are these issues, but has sort of been dealing with them in sort of an ad hoc, one-off kind of way. And I think that has real implications for the economy looking forward. If you think about how many businesses in the United States, have a relationship with China, whether or not they manufacture there or they sell their products there, I think it's going to be really important for those businesses here in the United States to get a lot of clarity around what the government thinks is totally okay. Maybe that's like kids' toys and diapers and those sorts of things, no problem. But sensitive technology, chips, things that could be used in weapons, probably not okay. And I think the sooner that the United States government can be clear about the areas where they think business cooperation makes a lot of sense, and also clear about the areas where it's, maybe not okay, the more stability we can have in our economy, and I think we can, maybe better strengthen that relationship. I think it's the uncertainty that's tricky. So, I think the more the government can share about how they're thinking about those risks and, really create some clarity for business, that'll be helpful.
Now, TikTok's not banned yet. There is uncertainty for some of their really important stakeholders like creators or advertisers. What are you guys doing to take advantage of that uncertainty right now?
The most important thing we can do is just focus on our own business. Folks have lots of alternatives when it comes to short video. They can use Spotlight, which is on our platform, or YouTube Shorts, or Instagram Reels. So I think there are a lot of different opportunities in the short video space. So what we've continued to do is just focus on what creators love about our platform, which is the relationship they can form with their audience. And that's primarily through our Stories product. So creators love using Stories to just show what they're doing throughout their day. And because we revenue share, creators don't feel pressure to do all these brand deals. So Snapchat content just feels very authentic, which is why their viewers and their audience, really love it, and why that resonates with them. And then they use tools like Spotlight to get more distribution, to help people discover them, so that they'll, add them and watch their story on an ongoing basis. So I think that's a pretty unique value proposition we have for creators, and we're just going to, really stay focused on that.
Snap CEO Evan Spiegel yesterday. Coming up, well, we're going to be deep diving into Grindr. George Arrison's joining us, the CEO of that business, hot on the heels of its own earnings report, so more on social in the LGBTQ context. Meanwhile, watching shares of SoundHound AI. Shares actually trading higher, more than 13%. That's as we see the voice AI software company reporting first quarter revenue that really smashed expectations. They gave a revenue outlook range for the full year that met the average estimates as well. But Cantor Fitzgerald saying they're announcing several new partnerships across automotive and restaurant end markets. This is Bloomberg Technology.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Let's talk earnings now, with Grindr posting its first quarter results showing revenue growth 35% year over year. Let's discuss all of it, the margin as well, and the expansion of products. Grindr CEO George Arison is here with me. And George, you're saying in your statement this was a really strong set of numbers. Still loss-making, but much smaller loss. How are you...
It's not a real loss from like a financial perspective, because it's all warrant related. So we have warrants because we did a SPAC, and warrants are held as a liability, right? And so when you account, we have an operating profit and then a loss because of the warrants. So from the business perspective, we didn't lose any money.
And an adjusted EBITDA that's showing margin, that's improving.
We did very well on EBITDA, 42%, which I think is really healthy, and we're investing in the business at the same time.
And where are you investing? Because you do talk about your product roadmap, the fact that you're bringing 2 key products to bear, a lot of technical innovation when it comes to the chat part as well.
Yeah, so that was a really big launch for us. We launched a new chat architecture. People would lose chats every time they switched phones before, and that was a huge complaint. So it's not going to happen anymore because chats were hosted locally on your device, so we moved away from that.
Yeah.
We are, when I joined, we didn't really have a long-term product roadmap. We spent a lot of time last year working on that. We believe there's huge extension opportunities for the product, extending it more into dating, building feature set to support dating, and do that not in terms of what other people do today, but what dating world will look like in 2 years.
And what does that look like?
Well, AI is going to be first, right? Like, I think people will expect that social networks will actually drive connections through AI rather than through filtering. Because today, the dating platforms haven't really fundamentally changed. It's you come to a page and then you filter what you're interested in. I think that's going to really change.
So you're going to be pushed to people because the AI can already understand you.
Exactly, either from activity that you do on the app or even activity from the outside the app, right? Like, there's so much information in your text messages about who you are, what you're into. What if there's a world where you uploaded a bunch of your text messages and we use that to understand who you are? I'm not necessarily saying we're going to do that, but those are the kinds of things I think that AI will allow companies like us to do. And so we don't have a broad dating-specific feature set today. We have a lot of dating that happens in the app through conversations and chat, but not in terms of like features for dating specifically. And so as we build that out, I think there's a huge opportunity to kind of skip over the world we're in today and go directly to the world that will be coming in a couple of years.
What's interesting is, of course, that means that you have to have a lot of your community buy-in to that. From a security perspective, and I know that at the moment in the UK, for example, you have been sued because of what you claim is a mischaracterization of the way that you were running the businesses practiced 4 years ago. But when there is a concern about privacy, how do you push that forward?
So 2 things. One is, for us, privacy is paramount. In 60 countries around the world, being gay is illegal. And we have users in most of those countries. And so we need to really protect our user privacy because it's not just a matter of like good for business, it's a matter of their life and death in some respect. And so we take that really, really seriously, and we do a lot to protect user privacy. That's why you can get on Grindr without giving your photo, for example. You don't have the verification to support user privacy. Secondly, we've never shared any HIV or medical information with any advertiser ever, so it's a complete mischaracterization of what Grindr doesn't do. We've never done that, and we never will. So we're going to fight that lawsuit, obviously, very vigorously, because we don't think it has merit. But it's also important to remember that whatever they're saying might have happened, which is not true, they are claiming happened a long time ago, 2 managements ago. So this is a very different regime at Grindr today than was under Chinese ownership in 2018. So, I think that's an important thing as well. I think users have to trust us. That's really important for us, and that's why we make privacy such a big deal at the company.
I wish we had longer, but we've got about 30 seconds. One thing, you are hiring again?
We are. We've grown our Inch team about 50% in the last quarter, and we have a lot of roles open across the company.
George, come back. Thank you for talking us through it all. Grindr CEO George Arison on that 35% year-on-year growth in revenue. Coming up, we're watching shares of Bumble. Well, kind of linked in the dating space. Bank of America are actually upgrading the online dating company to buy from neutral on both valuation and upside to growth. But no, we're under pressure by some 1.2% on the day. So I'm afraid that Bank of America know not enough to galvanize any risk on attitude there. This is Bloomberg Technology.
Season 2 of The Circuit. We're walking with the titans of banking.
Hello! You guys love these meet and greet things.
Me too. And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass.
That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
In New York, I'm Manus Cranny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in San Francisco. And let's just get you a quick check on these markets, because today we're currently seeing, well, the market just a little bit sanguine on the broader benchmark, but the NASDAQ 100 actually turning into the green now. Look, we've had a relative wealth of overall context coming from the Federal Reserve. We've had Fed speak, still saying, look, we're going to be keeping these rates higher for longer. You've also had, on the flip side, some slightly weaker economic data when you're looking at consumer sentiment. Add that together, and look, we're just still up about 0.2%. And in fact, we're on course for the best, well, a 3 straight week winning streak when it comes to benchmarks. Actually, the longest winning streak that we've seen since back to February. So we're currently higher. We're seeing the stock 600 on a tear as well. Europe, once again, seeing another day of gains, and that's been ramping up higher as we see earnings doing well. We're seeing 10-year yield just up 4 basis points, though, so still factoring in perhaps some of the supply that we've seen this week from the bond auctions, but also perhaps still some sensitivity to Fed speak saying we're higher for longer. Move on and have a look at some of the individual movers that we're having a look at, because ultimately we've got, well, key TSMC moves that we were just shining a light on at the previous part of the show, that TSMC up more than, well, call it 5%. Another great month. April just showing that revenue is higher and growing at a faster pace than the market had anticipated. Of course, ongoing AI demand, but also factor in a global scene for smartphones that seems to be bottoming out and seeing some recovery in revenue growth. So key for that chip maker. We're looking at Tesla off by 1.5%. Whether that's the reversal that we've seen on its superchargers, whether or not it's also the fact that we're getting more tough talk coming from the US. Bloomberg reporting that maybe we'll see increased tariffs coming on Chinese EVs in particular. And what would that mean for the tit for tat? Could that hurt Tesla a little bit? So we're seeing it just down. Nvidia up 1.4%. Doesn't look like some of the chip makers are going to potentially be hit anymore when it comes to the tit for tat with US and China. Remember, we've got Nvidia earnings still to come. But meanwhile, I want to take a quick look at another key stock, Akamai, currently falling. Now, this is after forecast for revenue and adjusted earnings per share came in, well, less than where the market had wanted to see it. Here to walk us through some of the numbers and the content distribution part in particular that seems to be the weakness is the CEO, Tom Layton. And security revenue was good, up 21%. Compute revenue good, up 25%. But it's the delivery revenue that is under pressure. Is that what's really hitting the revenue forecasts?
Yes, exactly right. Internet traffic always increases, but it's not in a straight line. And we have the world's largest content delivery network. And so when there are dips, we feel it. The good news is that we really diversified our business beyond delivery to the point where now 2/3 of our revenue is security and compute. And as you noted, both of those businesses are very strong, great growth and great potential. And I think over time, as we have more and more of our revenue from security and compute, the dips you get from time to time in internet traffic, we won't see as noticeably on our overall performance.
Interesting. Diversification key. What took me, my interest, was a large social media customer optimizing its costs, is what was put forward as to why you've downgraded some of the outlooks. Who is the social media player? Are we seeing that more broadly, or is it just one?
Well, we do have a very large social media company, and they are cutting back as best they can on costs, facing some geopolitical pressures. I would say more broadly, we've seen sort of a weak past couple of months in the gaming vertical and in video. And there's been a lot of reports out there talking about, subscriber numbers, and traffic as a whole. And so we feel that because, we carry all the video out there and a very big supplier for the gaming companies. And so that creates a little bit of a dip in our outlook for the year. That said, we raised our outlook on security and compute. Both of those businesses very strong.
Tom, you're the perfect person to therefore ask, because I'm reading between the lines here. A geopolitically affected social media company has got to be TikTok. And I know that you have expertise when it comes to security and more broadly an exposure at the moment that we're seeing of US companies to China. How much are you seeing geopolitics weighing on your business and the business of your clients?
Well, there is some concern there. We made a disclosure that in particular, if the law does take effect, banning TikTok, that could impact about 1.5% of our revenue next year. It shouldn't have a direct impact this year, and it remains to be seen if the law will go into effect.
Are you trying to diversify out of exposure to China more and more, Tom?
Well, we want to diversify our company as a whole. Today, we have 7 customers at 1% of revenue. The goal is to have a broader and broader base. And I think we've done a really good job of that, both within the customer base and also across product lines and geographies. So that, you won't see much of an impact, as we go forward when, particular things happen on the political stage or you get a dip in traffic.
And with the wealth of patents that you have and the focus on security, where are we in the cybersecurity landscape? How much are you seeing, in particularly in the age of artificial intelligence, it becoming harder and harder to ensure that we are protected in some way from our data?
Yeah, things are in a very challenged state with cybersecurity, particularly with the advances in Gen AI, which, as of now, are very helpful to the attacker. It's much easier for them to generate very malicious malware. We're seeing a lot more breaches, and I think the key now really is to develop the internal layer of defense for an enterprise. Because probably you're going to get breached, and the key is to identify it quickly and to proactively block its spread. And there we have the market-leading solution with Guardicore to stop the spread of ransomware and data exfiltration malware, and that's a very rapidly growing segment for us.
And a key acquisition made. Tom Leighton, thank you so much for spending time with us, the Akamai CEO, on all of geopolitics and indeed the revenue from the business. Meanwhile, at our Bloomberg Technology event, I actually talked a little bit more around AI, but the infrastructure within, coming from chip makers, Ampere Computing. The CEO, Renee James, was on stage with me to discuss the state of, the semiconductor industry, some of the competition there. Take a listen.
I had worked in semiconductors, obviously, a long time, and one of the unexplored areas was continuing to deliver performance, but a lower and lower and lower power. Because one of the things that we had the luxury of doing in the early days of high-performance semiconductors was just to use more power, make them more powerful. They got faster, but we threw more power at it. So when we started the company, we said, we don't need to start a company to prove that we know how to make semiconductors or that to do what we'd already done. So really what we wanted to pioneer is what we call, technical term, efficiency frontier, which is that knife's edge between super high performance but at lower power. And up until the time that we started Ampere, low power meant low performance.
Okay.
And so people would think about it and they'd be like, oh yeah, we have a super low power device. Like, is it for a cell phone or is it, whatever? Even though nowadays phones are super powerful. So we endeavored to build products that could be air cooled. And we, of course, had been building microprocessors, my core team and I that started the company. We'd been building microprocessors for a long time, as you pointed out. And we, of course, knew that, that ML, AI was a major workload. So we were thinking a lot about how much power it takes and how are we going to even be able to build all these data centers? Because we had been a team that had worked together on the first phase of build out of what you now call hyperscalers. And we knew how big these data centers were getting and how much power these chips, the combination, right? So that was our thesis. You can do this at lower power. You can do this in a way that enables all these workloads and stay air cooled, which means you don't have to build a brand new data center with liquid cooling and that you can stay within the envelope of kind of, think about being landlocked. When you build a data center, you have a certain amount of power in that footprint. How are you going to ever upgrade to better compute?
It's a relatively new chip company, and it's making inroads into market share. Ampere Computing CEO Renee James there. Of course, 28 years she'd had at Intel before founding her own company. Coming up, we're going to be joined by Index Ventures partner Nina Achadian. She's going to get her take on AI investing trends, of course, where she's seeing the hype and the reality. That's next. This is Bloomberg Technology.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
I think 2024 is going to be a monumental year for AI.
The current generation of models that we're seeing out there is still in the $100 million range. You know, I think all of this can scale to the $100 billion range.
Llama 3 should not be open source. It's a national security hazard to open source.
We are trying to be the most responsible actors that we can be, and think about what are the potential externalities that could be caused kind of accidentally by this tech.
I also worry about the overhyping of human extinction risk. I think that is blown out of control.
I feel like today, every single company has to build their own AI. Otherwise, they run the risk of being left behind.
Get the theme there? It was AI. Across every single conversation yesterday when we were at the Bloomberg Technology event, and let's keep that conversation going. Hina Shadian is with us, Index Ventures partner, who joins us for today's VC Spotlight. And boy, you've been busy writing some checks, backing some AI companies, and are the valuations out of whack?
Well, thank you for having me, Caroline. It's great to see you. Yes, there is definitely a tale of two cities. If you are an AI company right now, you can raise in the 100x ARR multiple, but if you're not an AI company, it's still trending around 10x. So there is a huge discrepancy between the valuations for AI and everybody else.
Where are you seeing the value, therefore, in AI investments? Where would you want to be allocating checks when they are at a heady price point?
Yeah, so for us, it really comes back down to the basics. Is this company building something that has true ROI for their customers? And we're really seeing that a lot in the application layer, sometimes focused on very specific verticals. For example, we invested in this company called Viscom. They build software for industrial designers. So think anybody that has to design a shoe, a car, a piece of furniture. They use AI to help these industrial designers accelerate their process. And they had some inbound interest very early on from huge companies like Ford and New Balance. And so those are really the areas that we find attractive to invest. Clear customer, clear ROI, and of course, over time, we'll see more and more of these, hopefully.
You're leading the team here in San Francisco, and I'm sure there's many an entrepreneur who views us who's interested in how, therefore, Viscom gets your interest. How did they get your inbound? Do they come to you? Do you come to them? How are you finding out these jewels in the rough?
Yeah, well, for us, it's all about investing in people. And so we try to build relationships with folks very early. Sometimes this is while they're still at their current job, or it could be, through a network that we have of our own entrepreneurs. And so we really meet people in all different avenues, whether it's events, referrals from our own entrepreneurs, or even just outbound. And so we're always open to meet great entrepreneurs.
Where are some of the other use cases of AI really piquing your appetite? There, it would seem to be more the visual perspective in the way in which ultimately we can spark creativity. Look at the backlash that Apple's had. Like, there's a worry about creativity being stifled rather than augmented. But where else is artificial intelligence and generative AI reaping rewards for some of the companies that you look at?
Yeah, so I think the code generation space has been an area that a lot of people have talked about, and there's many companies that have popped up in the space, but that seems one that's an obvious use case, and we've already seen a lot of customers, even Fortune 500s, really putting down, commitment to try out these new code gen softwares, companies like Augment, for example, and others, and so we're really excited about that use case. And then if you think about anybody that's using pen and paper and has a lot of unstructured data, that really is ripe for the use of AI, because now suddenly you can make sense of all of that data and really integrate into your workflow something that will accelerate what you're trying to do.
That sparks my imagination back to our conversation with May Habib yesterday of Writer AI, and she was saying, ultimately she's getting a lot of calls from other companies right now who are running out of money and they would need to be bought. Is this something you're seeing of a generation of AI entrepreneurs that got their companies off the ground, but they can't sustain it from a cost perspective?
Absolutely. I think we're going to see a lot of consolidation in the space, because everybody talks about how it's a war for talent, specifically within AI. And it's just not sustainable that all of these companies can exist at very high valuations when they're still very early in revenue. And so, we saw that very early on with Mosaic and Databricks, of course, the Inflection and Microsoft partnership. And so I think we'll start to see more and more of that over time. And hopefully, 1 + 1 will equal greater than 2.
Are we going to get expect more of these weird kind of acqui-hires, though? Because the Inflection Microsoft deal was a relatively extraordinary one.
I wish I could tell you. It was extraordinary. We were also scratching our heads a little bit on it. But look, I think it all comes down to acquisition of talent. And I think for a lot of companies that have raised money and they're struggling to find that product market fit, I think it could be an attractive path for them moving forward.
We've only got like 40 seconds left, but where else if not AI? Where can still be a good investment?
Look, I still think this transition from doing things manually to digitizing them is really important for some of these massive industries. For example, there's a company that I invested in called CISO. They're trying to be the workday for the agriculture industry. So right now, in the agriculture industry, you have to do a lot of paperwork on digital onboarding completely manually. So doing things like that and helping those huge industries really transform to tech first, I think is a huge opportunity.
Wish we could talk more. Nina, thanks for coming in. Great to have you here. Nina Shadian, she's an Index Ventures partner, right, based here in San Francisco. Now, let's go back to the Bloomberg Tech event that was held right in this city yesterday. Flow co-founder, and of course, well known for being the WeWork CEO, Adam Newman, sat with our own Brad Stone yesterday to discuss his attempts to win back WeWork. Take a listen.
And we're just at the middle of all of it right now, but just to explain a little bit more about it. Our bid was $650 million. The bid that seems to be the one that they're considering to confirm at the end of the month is $400 million. It's a difference of $250 million. That number is very important. I'll explain in a second why. When in bankruptcy, and I'm learning a lot about, I've never heard anything about it before, so it's all new. I didn't think bankruptcy was a beauty competition. I thought bankruptcy was.
That is a line in your brief.
Yeah, it is a line in the brief. I thought it was whoever is going to give the best offer. And when you base it, well, what is the other offer? What's the plan that they're showing? So they show a plan and they give numbers. And just to share a few numbers in the plan that's going to be presented to the judge at the end of the month, the plan says that the average, two numbers that are very easy to track: average revenue per member and occupancy. The two numbers that the current plan is forecasting would be the highest numbers we have seen since 2019, which is as far as we can go, which I would call peak office, and would hockey stick, and they would have to achieve those numbers by the end of this year. I'll say a little more. The profit margin of the buildings would have to go from 16% margin, which is the last number that we saw right before it declared bankruptcy, to 24%. That is 50% growth in margin by the end of this year.
And this is under your plan or
their plan?
Their plan.
No, their plan.
So you're saying it's could be hyperbolic.
Oh, I'm saying it's definitely unfeasible.
But let me just ask you, I mean, don't the creditors have a legal requirement to take the best deal? So is there something, and you said it's not a popularity contest, so if it was, why, if they looked at your deal and perhaps had a legal requirement, and a very self-interested requirement to take the best deal, why do you think that they have bypassed?
So we're getting very technical, but let's say one.
I don't think it's a technical question.
Well, it is, because your real question you're asking is the judge obligated to take the best deal, or does the judge get to choose what deal he's going to take? And I think it gets quite technical, but let's say something else just about, back to what I said, from 16% to 24%, 50% growth in 1 year, without spending any money on on a business that now has aging buildings, in what I think is one of the worst office markets, maybe in the history, but definitely of the past 40 years. Look around just here in San Francisco, but it's a global phenomenon. If they achieve these very rosy plans that I think are unfeasible, they would then need to, in 2025, grow from that to not go cash flow negative.
The names that move markets are on Bloomberg.
With all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time, we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
It's going viral. That was part of Apple's recently pulled advertisement. Of course, for the new iPad Air, the company facing backlash online after the ad depicted, well, as you can see, musical instruments, TVs, paint cans, other creative tools being crushed into an iPad. Apple issued a rare apology for the advert and said that it upset many creators and other customers. The company also said it will not air the ad on television as planned. Meanwhile, let's just talk about healthcare for a moment and a huge acquisition that Oracle did, a $28 billion one, 2 years ago to acquire electronic records company Cerner, promising a revolution in healthcare technology. However, interviews with more than 30 current and former employees and customers show that the software maker has lost at least a dozen of Cerner's large clients. I'm pleased to say that Brody Ford is the guy behind the very well-read story. And so what? They're all in on healthcare, but the clients don't seem to like the tying together?
If you are anybody with a brain, it's hard not to look at the healthcare system in America and say, something's not right here. We could fix this. Apple's done it. Google's done it. Now Oracle's done it. Consistently, they found, hey, this is tough to disrupt, right? And so Oracle said that we can buy this company, which makes essentially, if you're at the doctor's office and they're taking notes, prescribing stuff, all the kind of software for medical facilities, they run that. They said, if we buy this, we can integrate these systems well, put it on the cloud, make it run easier. We're a tech company.
Generative AI, you know.
Throw some generative AI. Turns out it's hard. You know? So it's been really tough. They haven't been able to make the progress they've wanted. The company they bought was kind of on a downward trajectory. So, I mean, this is not all Oracle's fault, but in the 2 years since they've purchased it, the outcome has been revenues down, customers have left, they've fired 3,000 plus people. Wow. It has been tough going. And when they bought it initially, the talking point was, this is going to boost our earnings, revenue growth engine. Exclusive financials we reviewed show this has not been the case.
We've got 30 seconds, but the move to Nashville then, not going to happen?
Move to Nashville? Look, it's hard to say. I saw some other documents that when they moved to Texas, more people are still in California. So what does the headquarters mean? Is it a state of mind? Is it where all your employees are? We do not know.
It's a state of mind, Brody Ford. Nashville's a state of mind. We thank you so much for being with us. He's going back to New York. I'm going back to New York. That's it for this edition of Bloomberg Technology. Do not forget to check out our podcast. You can relive so much of the great content that came out of the event yesterday at San Francisco. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Shonali Basak, and Bloomberg Real Yield starts right now. Coming up, consumer confidence starts to break, but inflation expectations stay hot. And that's all as investors await CPI data just days away. But we begin with the big issue, the Fed's confidence to cut with messy economic data.
The Fed is looking closely at the data.
It's really looking at the totality of the data.
Inflation remains sticky.
Wage growth sticky, core inflation sticky.
The Fed is likely going to take the right view for the economy. We think that's going to be higher for longer.
I think later this year we'll get our first cut.
If they haven't cut in September, they're likely to cut in December.
The first cut comes in September and then another one in December.
We're looking for the inflection point.
I do think that he's looking for a reason to ease.
It's rare that the Fed would intervene before November, right? So will he remain patient through the election?
There's still a question of will inflation actually decelerate enough by then?
As the data come in, hopefully we'll be moving in the direction we want to see, both on inflation and in terms of restoring balance to the economy.
Now we're looking here at a double-edged sword. U.S. consumer sentiment declined in early May to a 6-month low, but short-term inflation expectations and concerns about the job market have picked up. You have to understand that what this means is the economy is softening, but with inflation still high, there is a question on how quickly the Fed can cut, and the current expectation is at least once this year. But if you flip up the board here, look at the credit spreads and the picture that we're looking at. They have collapsed across the board from investment grade to junk bonds, and the extra yield that investors get for owning debt instead of government bonds is the lowest in 2.5 years. And remember, the expectations for Fed rate cuts, now we said just one this year, potentially, that has changed drastically from earlier in the year where there were at least 6 expected. Yet spreads have remained ultra tight. Now, we caught up with Minneapolis Fed President Neel Kashkari on the sidelines of Milken, and here's what he had to say about inflation.
We're committed to 2%. We will get to 2%, and we will get an interest rate environment necessary in order to achieve 2%. The second half of 2023 surprised us at how rapidly inflation fell. It seems like it stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time.
Joining us now is Barry Knapp of Ironsides Macroeconomics and Skylar Montgomery Koning of TS Lombard. Barry, you look at the conflicting signs in the data, some things starting to weaken. Yields this week have been interesting in the shorter end of the curve because even though we saw it go lower last year, we've been wavering around that 4.8% level. Where do you think we go from here?
Well, I like the front end more than the back end. I still think of the three most plausible scenarios, one being the most likely, which is that rates move higher still, tends retest the 5% peak that they reached in late October amidst the increase in Treasury issuance of notes and bonds. That's the most probable scenario for me. The last month's employment report, or last Friday's employment report, did open up the possibility that we could get a string of weak labor market data that would allow the Fed to start the easing process, which would, painlessly disinvert the curve, bring the banking system back into all that issuance in terms of them participating in the belly. And then the least probable scenario for me is that we just muddle through and the Fed doesn't cut but rates don't move. I think most probable is that the back end is still going to retest that 5% level.
Now, I want to bring you some headlines also crossing the terminal here because Bloomberg had a conversation with Fed Governor Michelle Bowman, who said she doesn't think that it's appropriate for the Fed to cut interest rates in 2024, and she points to persistent inflation. Skylar, when you look at that prospect, the idea that we may not get a rate cut at all this year, what are the concerns?
Yeah, I mean, I think, for the Fed, they very much want to cut. They've kind of lopped off half of the distribution of what they could do policy-wise and saying that they're definitely not going to hike. I think, the problem is the economic data. The economy is strong, the labor market is tight, and there's definitely greater worries over sticky inflation after 3 months of upside surprises. I don't think we have to get back to 2% inflation for the Fed to cut. I think it's widely accepted that, maybe we get this revealed preference for higher inflation, but we definitely need downside surprises in inflation. We need a clear disinflation trend, so not just 1 month. And there are still plenty of months in 2024, so we can certainly still get 2024 cuts, but it makes sense that the market has pushed out those cuts, and it makes sense that, people are thinking about potentially not cutting this year. We just have to see how the data comes in the next few months.
Barry, we've been talking a lot here at Bloomberg about how rent is the last domino to fall, shelter costs. When we think about the inflation story, how sticky is higher shelter costs?
Extremely. If you think about the various measures of rent, the apartment list, which is new rents, or the Zillow Observed, which is more of a blended of existing and new rents, they peaked in mid-2022. Most of the academic research says that it should be about a year lag before it filters into the CPI or PCED measures. Well, here we are nearly 2 years past, and sure, it's come off, but we've lapped the 7-month period where we were averaging something close to 0.75 per month in the core rent of shelter measure. And it still hasn't moved down all that much below 6%. And if you look at those measures on a quarterly basis, they've turned back up along with house prices. So it's very unclear to me that we are going to get anywhere near the 0.25 monthly increases or 3% annualized increase that persisted through the 2010s. I think the Fed did serious damage to the housing market. They exacerbated the structural imbalance by the way that they tightened. Passive QT and aggressive rate hikes caused the deepest yield curve inversion since the Volcker era. So they damaged the supply side just as much as they damaged the demand side and just made things worse. So for me, I don't think that it's plausible to get to 2.5. And I would further go on to say that Kashkari's expectation that the Fed alone can bring inflation to 2% is not consistent with history, not consistent with the 60s or 70s. We would need a tightening of fiscal policy to bring that non-housing services component down, which is reaccelerated in the second half of last year. So I'm not nearly as sanguine about the inflation outlook as President Kashkari, that's for sure.
Skylar, what is your expectation here? We're just days away from another critical inflation print, and where are you the most concerned that we can still see things too high?
Yeah, I mean, I completely understand the worries over sticky inflation. On the good side, it's been very evident that we keep getting these rises in commodity prices, even if they've moderated in more recent trading. We have continued global political tensions, so geopolitics have, definitely been in the background, and that's meant continued shipping disruptions, and both of those things automatically feed into headline inflation. I think the bigger worry, because of the potential for second-round effects, is on the services side. Wages are, fairly sticky in the 4 to 5% range, depending on what measures you're looking at. And because we've had 3 months of a row in upside inflation surprises, it's harder to get that downside surprise. But what I will say is that in the U.S., there's been a supply-side rebuild. So the labor market has rebalanced with job openings declining in the industries that had the highest vacancies. And I don't think higher wage growth necessarily has to be inconsistent with disinflation if productivity is rising. So I think for us, 1Q was very much a bump on the road of disinflation. I don't think we settle back at 2%. That seems more unrealistic, but certainly we could get some downside surprises in inflation from here.
I think about what Carlisle's economist said earlier this week, Barry, and it seems to jive with what you were starting to say a little earlier about long-term yields, rising long-term yields, potentially much higher than what we see today. You see all these investors slamming the duration story. They're piling in really to the duration story. But what's the risk that they're wrong? What's the risk that yields on the longer end of the curve go much higher?
So the brand name for Ironside's macro is it's never different this time. And I do a tremendous amount of work on past periods. I think the applicable period here to just get a very long-term potential scenario or outlook for the Treasury market is to think about the 1960s, where we were unwinding the rate caps that existed through World War II. Banks had piled into Treasuries. It took them 30 years to wind those positions down. We just had a series of higher highs and higher lows as inflation rose along with more expansive fiscal policy through the course of the 60s. And I think that's very much the path that we're on. Having negative term premium on 10-year treasuries is really abnormal. And when you just look at that and line it up with the whole QE era, it's pretty clear that unless somehow we're going back to the zero lower bound because the economy comes unglued, which to me seems highly unlikely with this expansive of fiscal policy, I think we're just headed for higher rates and higher term premiums over time. So sure, we could have a real hiccup in the economy and have a move lower in rates, but I just don't see the policy rate settling in where the Fed thinks it's going. 2.6%, I think 4 is more likely as a sort of a neutral policy rate, and I think rates, the longer end needs to have a term premium in it, and that's where we're headed.
Team, we have to leave it there. Barry Knapp and Skylar Montgomery-Koning, thank you so very much for your time. Of course, critical economic data ahead. Now, I also want to bring you some news. Chinese EV maker Zeekr began trading moments ago. Zeekr Intelligent Technology opening at $26. That would be almost 24% above its IPO price of $21. Remember, Zeekr sold 21 ADRs, and that was more than planned last night at the top of its marketed range, so plenty of demand for this company. Of course, this is a high-end electric car brand under the Geely Group, and it is the largest listing by a Chinese-based company here in the United States since 2021. You can see it there with a market cap of almost $7 billion. Stick with us. More Real Yield ahead. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm Shonali Bassick, and this is Bloomberg Real Yield. And it's time now for the auction block, where global companies are seizing on strong demand and lack of clarity around funding costs to issue the most debt in years. Looking at U.S. high grade, there were nearly $56 billion of sales this week, way above estimates. CVS, Charter, and HSBC helping to drive issuance to the third busiest week of the year. The list of sales was robust, as you can also see names like Coca-Cola, UBS, and Hasbro. Monday through Wednesday, each saw 14 issuers for the busiest 3 sessions since 2021. It wasn't just investment grade. The credit party was also seen in high yield with almost $13 billion. Block, Hess, LifePoint helping to push the pace to the best since 2021. And Guggenheim Partners CIO Ann Walsh saying it's a good time indeed to buy credit.
Investment grade credit, great trade right now. Also, parts of the high yield market, particularly the higher credit quality part. I'd avoid the lesser credits. We still have some risk, being rationed at CCC rated credit that I'd be thoughtful about. And you could see some spread widening there. But historically, when the Fed's on pause, this is a good time for credit.
And joining us now is Will Smith, Director of U.S. High Yield Credit at AllianceBernstein, and Dan Zwirn, CEO and CIO of Arena Investors. Will, let's start with you quickly about how you have perceived the last week. There's certainly been a deluge of sales. Have you been a buyer?
We've participated in several transactions where we thought there was good value, but overall being really selective. I mean, this kind of reminds me of, for those of you who are fans of the NHL, we're in the playoff season now, and towards the end of a game, the losing team will attempt to pull their goalie in a chance to score that goal that puts them to tie up the game, but it leaves them really exposed. And it feels like there's a rush here for investors to buy as much as they can, but the risk is pretty great. So you really need to do your credit homework.
So I'm glad you brought that up because, Dan, you were actually quoted really recently in a Bloomberg story, and you said that there's this pretend notion that because default rates are low, everything's fine, but it's not about defaults, it's about recoveries and actual losses, what people miss. What are people missing?
Well, I think as a general matter, banks, insurance companies, and regulators, as well as agencies, tend to focus on defaults and interest rate coverage or interest coverage versus actual severity in these situations and the leverage that you're kind of taking on when you expose yourself to a capital structure. And ultimately, you can manage and create low default data by simply having very weak covenants. You can create very high coverage data by charging very little, right? Whereas you can't really fake it on leverage and severity.
It's interesting. Dan, double down on that really quickly here because this idea that data doesn't lie, sometimes it does.
Well, I guess the choice of data may lie, right? Ultimately, if you're choosing the wrong data to express a certain thing that it doesn't support, you can get fooled. And unfortunately, historically, people have relied on a kind of more homogeneous way of looking at credit in a way that doesn't necessarily anticipate changes that we've seen in the way people structure and think about credit today.
Will, we were kind of talking about this idea that spreads have remained incredibly tight despite expectations changing here around Fed rate cuts this year. Do you think that's warranted? How quickly can they start to blow out?
Well, it's always the really difficult question to answer. I mean, when spreads are wide, and it tends to be when the economy is weakening, most of the time weakening much quicker than folks anticipate. And that's always a really difficult thing to time well. Now, if you look at high yields in particular, there's really the story of the have and the have-nots. Similar to Dan's point, there's about 4% of our market that's pricing in a very high chance of default or restructuring of some sort. The other 96% of our market trades basically at the all-time tights. And that's concerning to us. And as we talk to investors, most folks are looking at markets and saying, well, I want to buy credit because yields look good, but I don't want to take any real downside risk, and therefore I'm going to crowd into high quality. And what that has done is basically made high quality bonds extremely expensive. It's not to say that spreads are suddenly going to widen, but your forward returns are just going to be challenged. You're not going to earn much more than treasuries if you're buying a BB rated credit at 120 basis points a spread. And what we think that really does is it opens you up to an environment that maybe looks different than the one we have today, i.e. growth slows, or pick your poison in terms of a macro event. And we always like to think about markets in terms of how much money we can make if we're right and how much money we can lose if we're wrong. And the reality is today, in most parts of credit, you can't make much if you're right, but you can lose a lot if you're wrong.
Dan, how do you feel about the risk reward?
I would kind of violently agree with that. And I think the point is that you have to define what you're looking at within credit. And so certainly within the tradable markets, both in corporate and ABS, it's super tight. And the compression we've seen between higher quality and lower quality is really very, very low. But that said, there's more than that kind of credit. And so when we look at things like credit within growth enterprises, the embedded kind of credit opportunities available in the secondaries market for LP interests, when we look at the entire market for commercial real estate, there's lots and lots of other types of credit where there is very, very large value destruction that's already happened, and the ability to kind of be a beneficiary of that has already begun.
Will, I feel like, and correct me if I'm wrong here, but the last time we spoke, you were a lot more sanguine about the state of credit, and it feels like something has changed. What has changed for you?
I think it's really two factors. One is just valuations, right? Spreads have continued to grind a lot tighter. And the second is really investor behavior and things that start to look and feel more like animal spirits out there. Folks kind of searching for that last risk premium, if you will. And that starts to be quite concerning, because that means that credit is being extended to areas where it probably shouldn't. You know, the likelihood that bonds are getting mispriced, we think is higher. And we start to get concerned that you're getting late in that credit environment where the chances that you get burned are significantly higher. So those I would highlight are the two major areas that have changed.
Dan Zwirn and Will Smith, we thank you both for joining us on these credit markets, certainly a hot topic. Now I want to shift gears. I want to bring you some breaking news. Jim Simons, the founder of Renaissance Technologies, has died at the age of 86, according to a statement by the Simons Foundation. Remember, he was the founder of Renaissance Technologies, and it was a hedge fund considered a pioneer of quantitative investing. He was known to hire quants and mathematicians, astrophysicists, and not your typical Wall Street type. He was the quant king and one of the richest people in the world. He passed away in New York City. The foundation did not cite a cause, and he was 86.
On season 2 of The Circuit, we're walking with the titans of banking.
Hello! You guys love these meet and greet things.
We do. And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money. You've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass.
That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
I'm Shonali Basak, and Chinese EV maker Zeekr began trading moments ago. Remember, it opened at $26 a share, the IPO at $21 a share. We are joined by Abigail Doolittle to discuss more behind the interest in this stock.
So this is a real positive, the fact that we now have had 2 IPOs in about a week where we've had very strong demand. As you mentioned, the stock priced at the IPO priced at 21. It opened at 26. Right now, it's closer to 27, up 27% on its first day. A market cap value right now of $6.5 billion. At the highs, the market cap value had been closer to $7 billion. As a way of comparison, Viking, which went public not so long ago, has a market cap of closer to $12 billion. Now, what's so interesting about this one, Shonali, is this is the largest IPO from a Chinese-based company. Of course, it's the EV, high-end EV brand under Geely that since 2021, since the Didi debacle, basically. They raised $441 million. That's up from what they initially were trying, closer to $370 million. The books closed on Wednesday, but they reopened it apparently yesterday, sold another 21 million shares total, and the second round that was sold yesterday at 21. So this is really, really positive. It was oversubscribed. Again, they reopened the books, additional shares, and the stock right now up 30%.
And just about 30 seconds here quickly. I mean, this comes against an interesting backdrop because the Biden administration is set to take a look at Chinese electric vehicles and announce more about it early next week.
It is very interesting. The optics of it certainly aren't very good. But if you go into the financials of Zeekr, they barely get any of their revenue from the U.S. It's basically all China and Europe. But again, the optics of it aren't good. And the choice of it by the Biden administration, you have to think that it's not a mistake. Again, the first big IPO from a Chinese-based company on a day that they choose to let that headline float.
Abigail, we thank you so very much. Of course, this IPO market staying hot, but of course, the rest of the volatility is still for next week, isn't it, with the CPI data ahead?
Yes.
Now, we have more on the trading of Zeekr as we go through the hour. Stick with us. More on markets next. This is Bloomberg.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big in American company, but I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So
right.
whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Welcome to Bloomberg Markets. I'm Shonali Bassick. A drop in consumer sentiment and hawkish comments from Fed officials are now keeping traders in check. Let's get a check on the markets here because you have an S&P 500 still in the green. It's been a bit of a green week for the S&P, and you have it up but barely. It's pretty much flat on the day. NASDAQ 100 also seeing a little bit more love there, about 0.1%. Two-year yields, remember, this is where you have a little bit of a sell-off today. You're still below 490 meaningfully, but you are up by about 4 or 5 basis points on the day. Risk appetite hitting Bitcoin moving lower here. Under that $61,000 level, it's down about 2.8% on the day. Let's talk about some midday movers here on the equity side. Yelp shares are struggling after it adjusted guidance for the full year. Macro headwinds for restaurants and growing competition from delivery platforms could also pressure its revenue, and that's according to analysts over at Jefferies. Yelp shares down now more than 4%. Meanwhile, Sweetgreen revenue topped estimates, and it boosted same-store sales forecast for the full year. Analysts were positive on the upgrade, highlighting improved margins and profitability as its strategy gathers pace. Sweetgreen just soaring, higher than 35%. And Zeekr has begun trading. Remember, it's up more than 30% on the day. We will talk more about that IPO a little later this hour. Also today, Dallas Fed President Lori Logan says that it's just too early to think about cutting rates. I need to see some of those uncertainties resolved about the path that we're headed, and we need to remain very flexible to policy and continue to look at data that's coming in and watch how financial conditions are evolving. Let's bring in Bloomberg's Michael McKee to talk about these comments a little more because, of course, when you look at Logan, when you look at Bowman, of course, there is some concern here, Mike, about how quickly the Fed can actually cut when you're getting voices of dissent within it.
Well, we're sort of getting a range of views that all consolidate into a very narrow view, and that is that the Fed's going to be not cutting rates for a while. Now, within that, you can find different people on the spectrum, and Mickey Bowman is out now, probably the farthest over in terms of putting it off, because she says we're not going to be cutting rates this year, or at least she doesn't want to. Speaking to Bloomberg in Dallas, Texas today, she said, I, at this point, have not written in any cuts. I've sort of had an even expectation of staying where we are for longer, and that continues to be my base case. So don't count on her for a vote right now. You can look to the others who think that maybe we get to it by the end of the year. Raphael Bostic this morning saying maybe one cut later this year. Now, Lori Logan's looking for data, as they all are. And next week, we get a lot of it, Shonali, that could influence people's thinking on the Fed, but probably more influence people in the markets. We've got PPI on Tuesday and Jay Powell speaking on Tuesday. Now, the big news of the week is the CPI report on Wednesday. Powell won't have seen that, so he's probably not going to say a whole lot different, but everybody's going to be paying attention anyway. We also get retail sales. We'll see if, Shonali, you helped at all the U.S. economy. A lot of banks think that we might see an improvement in retail sales, but the forecast is not for good news. And then the CPI forecast, as you can see on the right-hand side there, we are not expecting a big change, but we're expecting it to start to go back down again. And that's going to be what the Fed is looking for, at least some progress, what all of these Fed speakers are looking for, some progress towards 2%.
First of all, if you watch this show, Michael always brings us through what you need to know for the week. So I feel like you really targeted the hot spots to watch. Second of all, I am helping the economy out, shopping a whole lot these days. But third of all, I don't feel apparently like the average consumer does today. There seems to be confidence dropping off, but those inflation expectations seems to be driving yields higher. Can you put some perspective on this?
Well, it seems that inflation is what's driving the decline in the Michigan survey numbers today. We saw a big drop in not only headline, but current conditions and in expectations. And according to Joanne Shrew, who runs the survey for the University of Michigan, it's largely people's comments about inflation. I asked if the wars were making a difference, and she said, no, people don't mention what's going on in the Middle East that much, and they don't mention Russia and Ukraine that much anymore. And so, somewhat surprisingly, they're not mentioning the presidential race as a reason they're discouraged. They're more worried about inflation, and they're more worried about the fact that the news media is reporting a lot about the possibility of unemployment rising.
Mike, thank you so much for keeping an eye on all the data. Busy week ahead. I hope you get some sleep before that week. Now, while Fed officials signal interest rates are at their peak, Bank of America says appetite for longer-dated U.S. bonds has shot up. Let's discuss this with Bloomberg's Catherine Doherty, because, of course, we know Bank of America knows something or two about buying treasuries.
That is true. Yes, good point. But no, this is their clients that they're asking, basically the sentiment that they're trying to get across the street. And what they're finding is that this bar for further rate hikes, it's set very, very high. So I don't think that there's as much of an expectation for rate hikes. So what does that mean? It means that everyone is then expecting that if there's no further rate hikes, it's triggering this dip in buying. But what's also interesting is that even though the survey is showing that their clients are feeling this way, this is the sentiment, the positioning does not yet reflect these results. So I thought that was a kind of interesting comparison here that the bank is pointing out. They're saying that the gap between the sentiment gauge and the actual long U.S. duration exposure, it's yawned to its widest ever.
You know, what's interesting about this, Cato, is that, and I think that might be the first time I use your nickname on television. Very sorry about that. But, you know, you cover Bank of America very closely, and this is one of the banks that has been benefiting from the great underwriting boom as well. And I'm wondering if some of this is just signaling the great investor search for yield, longer dated U.S. bonds, corporate bonds, like they're coming out of the sky. What do you think?
Absolutely. So if rates do stay higher, you're going to see, think about it from the consumer standpoint. If you have a CD that's rolling off, you might buy another one because those rates are still going to give you a certain amount of yield that if you want to have something that you know reflects in the next 13 months, you're going to get a return and not have as much risk. You might choose to roll over into a new CD. And I don't know if a year ago that the street would have expected we would be here today with rates where they are.
And it's interesting, you see those banks still coming out with some of those promotional offers on those CDs. That is Bloomberg's Catherine Doherty. We thank you so much for making sense of it all. Now, coming up, we're going to talk about the hot IPO of the day. EV maker Zeekr goes public in the biggest Chinese IPO in the United States since 2021, the largest in years. Stick with us. This is Bloomberg.
names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Markets, and I'm Shonali Bassick, and it's time now for the stock of the hour. Novavax signed a $1.2 billion licensing agreement with Sanofi that includes commercializing a combined COVID-19 and flu shot. Bloomberg's Madison Muller is here with the details. And Madison, what does this really bring by means of distribution for this COVID shot?
Yeah, I mean, this is important for Novavax because Novavax has really struggled to get their COVID shot, to a lot of people. Obviously, we know that Pfizer and Moderna have really taken the majority of market share and have really captured the public attention when it comes to COVID shots and their mRNA COVID vaccines. And Novavax was sort of a late comer. They came later to the game with a protein-based COVID vaccine, so it's a little bit different than the mRNA-based COVID shots from Pfizer and Moderna. And just because they came a little bit late, because people weren't as familiar with their product, it's sort of struggled to take off in the same way. I mean, we know obviously now that COVID shots sort of across the board are struggling with demand. I mean, this is something that we're seeing with Pfizer and Moderna, obviously. But this is, partnering with Sanofi will help, hopefully. I mean, the idea is at least to help commercialize and get Novavax's shot to a greater share of people.
So what's the future look like here? This is a sizable partnership, of course. $1.2 billion has some sticker shock to it. Can we see more deals like this?
That's a good question. I mean, when it comes to, it's interesting because what we're seeing too is that Sanofi and Novavax are going to partner to make a COVID flu combination vaccine. And this is something that we are seeing with Pfizer and Moderna as well. They're trying to use their mRNA technology to make COVID and flu combination vaccines as well. And so we're seeing more momentum in this field, and it will be interesting to see if we will see more partnerships like this going forward, sort of like Pfizer and BioNTech did during the pandemic. But it's something like, it's interesting to see COVID still play such a big role in some of these deals and partnerships because, like we've seen, it's really been an area that has seen waning and decreasing demand for some time. And so I guess it's an interesting question whether we'll see more partnerships like this going forward.
Bloomberg's Madison Muller, thank you so much for covering this story for us. Now to the next story. Chinese EV maker Zeekr began trading this hour. And remember, this comes just as the Biden administration is poised to unveil a sweeping decision on China tariffs as soon as next week. Bloomberg's Abigail Doolittle and David Welch are here with the details, starting with Abigail, because the demand here for this IPO has been pretty exuberant. Yeah. There has been a lot of questions about how much the IPO market can hold up. How much demand are they really getting?
It seems like this one is really showing that the IPO market is pretty healthy, especially when you put it in the light of Viking just about a week ago or so. It was oversubscribed. The books closed apparently on Wednesday, but they reopened them at 21, which was the higher side of the range, and that's what it priced at just yesterday. So they raised $441 million. Right now, the company has a market value of $6.6 billion. Now, it's interesting. If we put this into the perspective of Tesla, it's at about $540 billion, Rivian, $9.9 billion, and then Nikola at $733 million. So it's sort of closer to Rivian in terms of market value. But this is the biggest IPO for a China-based company since 2021 and the Didi debacle. But, you know, a lot of positive interest here. And maybe it's going to open up the U.S. IPO market more for some other Chinese companies, although there's these Biden headlines, which makes an interesting tension. The optics aren't great.
David, talk through some of the considerations here when we're thinking about these tariffs and what the administration is planning. Because even though you have a point that Abigail made a little earlier, Zeekr in and of itself doesn't have great exposure to the United States. But how could this really tackle some of the issues that we're seeing here?
None of the Chinese EV makers do have exposure to the U.S. yet. I mean, very few vehicles of any kind are actually exported to the United States. What the companies are what the government's worried about, and I would include Trump's people in this as well, should they win in November, is the Chinese makers, they're making great inroads into South America and Mexico right now. They could build EVs in Mexico and export them here, or they could export them from China, and they have a huge cost advantage because the supply chain for EV batteries, EV minerals, all of those things is much more mature in China. They have a great cost advantage even over Tesla in a lot of cases. And they sell these cheaper vehicles here that not only impacts General Motors, Ford, and the former Chrysler part of Stellantis, but think about all of the Mercedes, BMW, Toyota, Hyundai plants in the U.S. with a lot of jobs at stake. So the government's going to want to wall this off as much as they can and buy time for all of those companies, particularly Ford and GM, to catch up in the EV cost burden that they have. So that they can be competitive for the day when Chinese vehicles can get into this market.
What is the cost differential? You look at this IPO that you're seeing today, you see tremendous investor demand, whether it's from the United States or other investors around the world for this IPO listed in the United States. And you have to wonder whether investors are also picking up on that differential.
You're looking at most EVs in the United States sell to consumers for at least $45,000, usually well north of that. Chinese are selling EVs $10,000, $20,000. No, General Motors, with one of their partners, has an EV that sells for under $10,000 in China. It's a tiny vehicle. So some of the vehicles that you see priced very cheaply in China, they're not really appropriate for U.S. consumers, and they may or may not pass U.S. safety rules, and they would need some more engineering to do it. But they still have a multi-$1,000 cost advantage when it comes to batteries and EV drive components. And supply chain that we don't have in this hemisphere, really. That's all being developed as part of the Inflation Reduction Act to meet the requirements to get the tax benefits for consumers when they buy EVs now. But it's just going to take a few years to build that out. In the meantime, the government doesn't want a bunch of Chinese EVs being dumped here and undercutting everything that they're trying to do.
Abigail, how do we think about this moving forward? You were kind of talking about IPOs that have started to broaden in terms of scope here. Are we seeing enough breadth in the market for investors looking to chomp on new stock?
I think right now we do have that sign that in terms of this one being so oversubscribed, and also again the strength for Viking, that there is there's been so much reticence around the IPO market and the capital markets. We had a couple of big ones last year that did okay, but not wonderfully. So I think investors really are going to look for these kinds of signs. What's really interesting is that some of the other China EV makers, they are trading with the Biden headlines. They are down, such as NIO and Li, whereas we have Zeekr soaring at this point up 27%. So that's sort of an interesting bifurcation to me. And something also interesting, this of course is a spin out from Geely. This company has $32 billion. So this is a big deal. I think, again, it really signals that there could be not just an opening of the IPO markets for U.S. companies and investors, but also possibly for China-based companies.
Even with all the issues you're seeing in terms of the Biden administration and tariffs, it's interesting. Viking, even with a tough week of trading, it's above its IPO price.
Yes.
You know, what's interesting here, too, David, is you see a Chinese-based company listing in the United States. What does it also say about investor demand for EVs at a time where over and over we've really been talking so much about the difficulties in that industry right now?
Well, the EV slump in the U.S. is a little bit overblown, honestly. It's just not growing at 50 or 80% like it did a couple of years ago, but it's still growing, 5, 10, 15% in the U.S. But a company like Zeekr and really all the Chinese automakers, there's plenty of growth for them to get in the Chinese market, in Southeast Asia, in South America, and Mexico, and in Europe for that matter, where the U.S. EV makers aren't really capitalizing on just yet, and even some of their competitors in Japan and Germany, they're not really up to speed. So if you're looking for a growth story, the Chinese EV makers just have such a leg up in terms of developing the vehicles and batteries that all the other established competitors around the globe aren't ready to take advantage of. So wherever they want to go in the globe outside the U.S., where there isn't great EV growth anyway right now, good but not great, there are plenty of vehicles to be sold and plenty of consumers to be found. And so I can see why investors would be grabbing onto this as the next big EV growth story.
Bloomberg's Abigail Doolittle and David Welch, we thank you for making sense of the story from all angles. And next hour, Zeekr's CFO will be talking to us. Of course, remember, this is the largest Chinese IPO in the United States in years. Looking forward to that conversation. Stick with us for that, and stick with us for the Wall Street Beat next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
is Bloomberg Markets, and I'm Shonali Bassick. Jim Simons, the founder of Renaissance Technologies, has died at the age of 86. That's according to a statement published by the Simons Foundation. His hedge fund is considered a pioneer of quantitative investing, and his technique was so successful that he became known as the Quant King. Let's discuss this with Bloomberg's Kathy Burton, who has covered much of the legacy of Jim Simons and Renaissance Technologies, of course. Tell us a little bit more about what people are saying today, what he's most remembered for.
Well, Jim is a pretty interesting character because not only was he an amazing hedge fund manager, and no one could ever figure out how he made so much money, but also he was a great mathematician and a great philanthropist as well.
Speak to a little bit more about his philanthropy, because a lot of people who think about Renaissance, and we can talk more about it in a minute, it was very well known that he was hiring people that were not your typical Wall Street bent. But what about his philanthropy?
He had a large foundation, and he helped fund other foundations for his family, for his children. And he gave a lot of money to education, to mathematics in particular, teach for a mathematics program to teach mathematics in grade schools, and also autism was something that he gave a lot of money to as well.
And he taught himself for a while as well.
Yes, he was a professor. He was head of the Stony Brook mathematics department and really brought it up to be a major mathematics department in the world.
Set up Rentech for us here, for those who don't know what Rentech was in the world of money management.
It was a quantitative fund, as you said, which means it uses computer models to trade. And it was really the first quantitative hedge fund. And it was also incredibly successful. It had one losing year in its, I think, second year of operation. And after that, it annualized at about 40% a year. And that continued even as more competitors came into the market, and it was cheaper to use computers, so people had more computer power, and yet he was able to always beat all his peers.
I believe he was kind of one of the earlier ones, wasn't he, to close off the fund to new investors?
Absolutely, because he realized early on that you couldn't make big returns if you had a lot of money. The trading costs were just too much of a burden. And so he capped it at about $10 billion. It would fluctuate a little, but $10 billion was about the level.
He also didn't have a traditional way into finance. He was a code breaker for the government.
That's correct. A job that did allow him to do a bunch of mathematical research while he was working for the government. And then he got fired from that job for writing a letter against the Vietnam War. And then started out at Stony Brook, but he decided he was interested in trading.
Kathy, we thank you so much for your time here. Of course, Kathy Burton speaking on Jim Simons, who was the investor behind Renaissance Technologies. He died at 86 years old in New York City, according to his charitable foundation. Now, before we let you go here, taking a quick check on the markets before we head into a very busy week next week. Of course, we are looking here at a market that is holding on to gains and a bond market that is starting to lose some steam. That is it for Bloomberg Markets on the day here today. Of course, a lot of markets up ahead, and of course, more coverage of the late Jim Simons, who of course was a legend in markets. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
New tariffs on China could hit as soon as next week. Welcome to the fastest show in politics as the Biden administration prepares to unveil these new levies on EVs, on batteries, on solar cells. I'm Joe Matthew alongside Kaylee Lyons in Washington. And Kaylee, it looks like the administration here is trying to differentiate itself from the Trump tariffs by being surgical instead of this across-the-board approach. We'll see how it goes.
Yeah, keeping in mind the Biden administration has left intact the tariffs that were put in place on Chinese goods under the Trump administration. But whereas Donald Trump is saying, I'm going to tariff everything coming out of China, something like 60%,
yes,
the Biden administration is looking at a few key specific industries. It's worth pointing out, Joe, that a lot of this may be more symbolism than actually something that will affect the import of Chinese goods into the U.S. because a lot of them aren't in the Chinese or the U.S. market right now. That's because of the tariffs that are already in place.
Well, specific to EVs, we're talking about a potential fourfold increase, according to the Wall Street Journal. And what a bit of timing today, Kaylee, to see this Chinese EV maker Zeekr go public at the NYSE. We're going to talk to their CFO a little bit later on this hour with a lot of questions we have about timing and why this is happening at all.
Yeah, not just the questions around tariffs, but also why they're choosing to come list in the United States, given all the concerns that Chinese firms and their ADRs have had here, questions around auditing, potentially getting delisted from exchanges. Remember when Didi went public and then very quickly had to delist? So we have a lot to talk about this hour, and we also have to check in on the Trump trial that is underway still in New York. We'll have the latest on that. First, though, also in New York, let's get the latest on the markets. Charlie Pellet has a look at that for us. Hey, Charlie.
Well, hello there, Kelly. We're looking at an up week, 3 in a row for the S&P 500 index, and up Friday for now. A little changed on the S&P 500 index, higher by 4 right now, up less than 0.1%. We got the Dow Industrials up 107, up 0.3%. The NASDAQ Composite Index down 18, drop there of 0.1%. Bottom line here, the U.S. stock market is running out of steam amid amid stagflation chatter. The 10-year, 4.50%, with a 2-year right now, 4.86%. We've got spot gold up $21 the ounce, $23.67 right now. That is an advance of 0.9%. Crude oil lower now by 1.1%, below $79 a barrel, $78.38 right now on WTI. Shares of Sweetgreen, the salad chain, are surging after last night's earnings report. Sweetgreen up now by a sweet 33.6%. We're also keeping an eye on Zeekr Intelligent Technology Holding, a stock you guys were talking about at the top of the show. Zeekr, first day of trading went out at 26, right now 27.49 for Zeekr Intelligent Technology Holding. Again, recapping, looking at a mixed Friday here. The Dow, the S&P, they are both higher. S&P barely. We got NASDAQ in the red, down now by 0.1%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet with a look at the markets and the trading action we are seeing in the debut of Zeekr. Again, Joe and I will be speaking this hour with Jin Yuang, the CFO of that Chinese company that is listing here in the U.S. today. And what a day for that interview to happen, Joe, as we also had great reporting from our team here at Bloomberg overnight about what this administration is looking to do with tariffs on a number of things, but electric vehicles coming from China being one.
I'm scratching my head on this one. We're talking about a potential fourfold increase in EV tariffs, and we've got a Chinese EV maker going public today. I'll save my questions on that for later. Josh Wingrove is helping with our reporting from the White House, though, of course, Bloomberg White House correspondent is with us at the table right now with more on this. And Josh, this could happen as soon as next week, is what you're telling us. Will these all be rolled out in one event? How is this communicated by an administration that might not want to look like the Trump White House right now?
That's our expectation. It's going to be one event. Remember, they've already given a teaser with that announcement on steel and aluminum a few weeks ago in Pittsburgh, and so we think that they're going to roll these out. Right now, the tariff on Chinese auto EVs is 27.5%. So quadrupling that big number, I mean, it's still, I guess, possible that given sometimes the rate, the cost of producing goods there, that they could still try to find their way to be competitive. But this is really about sort of heading off what they expect to be, both in steel and aluminum, as well as cars, an increase that's coming as opposed to a market that already exists. I'm sure they'll frame it like, you don't wait for the hurricane to hit before you put the storm windows up, right? And they are expecting China to try to sort of dump its way out of its woes right now when it comes to steel and aluminum, and potentially try to overtake the auto sector. And as we know, the auto sector in every country has been a closely guarded political thing for quite some time. The 2024 overlays here are strong, but this is a big one. This is one of the biggest things Joe Biden has done on China in his administration.
Yeah, and it's worth pointing out that while we have had this administration taking this more targeted approach, it is in some ways, while they're both being protectionist, slightly more muted than Donald Trump, who says, okay, blanket everything with 60% plus tariffs. I'm potentially going to put 100% tariffs on all vehicles, he said in the past. What would hold the Biden administration back from doing something that intense or extreme?
Inflation, in part. I mean, that has been the argument against this. You start tacking on these things. Trump always said China's paying these tariffs. Of course, that's not the case, right? Tariffs are paid by the importer and passed on in part or in entirety to the consumer. So that was sort of hanging over this as well. I think one thing here that Biden has been weighing is, this is about sort of like a strategic long-term competition. You go back and watch everything Catherine Tai has said, everything Janet Yellen has said, and they talk about China sort of flooding the zone in key sectors, trying to corner the market on critical minerals, on overcapacity, key whatever. And they're trying to box the U.S. out and thinking long-term in a way that Western democracies don't always do or have the luxury to do. So right now, I think that is the lens on this. So autos, remember, of course, Michigan, key battleground for the 2024 election. If Joe Biden announces this, I'd be surprised if we didn't see him in Michigan pretty soon after talking about it. And then these other critical sectors, again, solar cells, we understand, is going to have a higher tariff rate, and maybe some battery components. It's still a little unclear. Other products could also see increases. We just don't know the full list, and we don't also know how much it's jumping. One final thing is that one scenario here was, well, Joe Biden might raise some on critical industries, key battleground type of industries, and lower others on more benign consumer goods, and trying to make it a wash overall to mute the reaction in China and perhaps mute the risk of retaliation that could hit, for instance, American farmers, as it did in the first Trump sort of trade spat with China. Our reporting is that's not the case. They're not exploring large-scale reductions in other categories that would offset the increases that they're planning.
That's fascinating. So this presidential campaign will in part be the battle of the tariffs.
And the battle over who can look tougher on China.
Who can be tougher.
Right. And they both want to look tough on China.
Doing this if it weren't for Donald Trump? You mentioned Michigan. He could potentially, you could see a world in which he had gone there on his own. But Donald Trump started this.
I think Joe Biden would bark up this tree either way. I mean, I'm reminded of the steel discussion and the Japanese buying U.S. steel. I mean, Joe Biden is an 81-year-old guy from Scranton, Pennsylvania, who doesn't like the idea of selling U.S. steel. And I think that is informing a lot of his approach. Joe Biden, under Obama, was tasked with rescuing the auto sector. The idea of Chinese EVs, putting aside the potential data concerns that a lot of people have with them, but just simply the market share question. Joe Biden, I don't think, would have liked that as well. So, we do have bipartisan consensus on a lot of these things, right? Biden and Trump are both using these tariffs. Of course, Biden's essentially deciding to keep in place the vast majority of the Trump tariffs, which, of course, a lot of Democrats didn't necessarily love when he put them in. So there is agreement here, kind of a rare point of agreement, to say the least, between the two of them.
Finally, when we're talking about the industries, at least that we know of, that your reporting indicates, EVs, solar, batteries that will power these green technologies. Doesn't the Biden administration want more of these technologies in the United States, right? They want to transition. They want to reach net zero within a certain number of years. By holding China back from being able to enter this market, does it actually run counter to some of those goals that they have?
This is one of the things that they're grappling with and why we will be paying such close attention. I would love to tell you right now. I would love to tell you. So right now, we just don't know what solar and battery type goods they will maintain or maybe even potentially reduce tariffs on because they're critical for feeding American growth in that sector versus ones that they're going to raise tariffs on to keep them out from undercutting the sector. It's a balancing act, and right now we just don't know how they're going to split it up.
Wow.
All right. Well, great reporting from Josh Wingrove and our team here at Bloomberg. He, of course, covers the White House for us. Absolutely fascinating. And to his point, Joe, the idea that everyone wants to be a hawk on China, and that doesn't just go for the presidential race. You could say the same about Congress as well. And protectionist policy, regardless of what administration ultimately we end up with come January 2025, it's probably going to be a common denominator.
Well, that's absolutely right. And you've been seeing the solar stocks, among others, move on this. Just incredible to think that, we're reminded in our last hour, this is the longest general election campaign in modern history. And we're going to be having conversations like this for months further, which could be a real strain on our relationship with countries like China.
Yeah, and not only is it the longest election campaign and general election campaign in history that makes this remarkable, it's also the first time we've ever seen a former president and current presumptive Republican nominee in criminal court at the same time that this general election campaign is underway. Because yes, it's another day in court in New York in the hush money trial of Donald Trump after Stormy Daniels had 2 days of testimony and cross-examination earlier this week. We understand that Michael Cohen, his former attorney and fixer, will be testifying on Monday. So where exactly do things stand for the prosecution and defense? Joining us now here on Balance of Powers, Robert McWhorter. He is a criminal and constitutional law attorney. Welcome back to Bloomberg TV and radio. It's always great to have you here, Robert. Let's just begin with Stormy Daniels. Considering the salacious nature of much of her testimony, the attempts of the defense to actually have a mistrial declared over it, does she end up helping or hurting the prosecution's case more from what you saw?
Well, I think that she certainly helped the prosecution's case. I don't think that the defense was very good at really attacking her or her credibility. She was able to hold her own ground, and I think she very well kind of presented what those facts were. But I do think it's important to put this in context, which is even if you do not believe anything that Stormy Daniels says, it does not mean that Mr. Trump did not commit a crime here. What seems, the defense doesn't seem to dispute that he paid $130,000 to Stormy Daniels. Now, either he was doing it because he had slept with her and he didn't want that story to get out, or like he's trying to imply that she's an extortionist and he paid it in order to keep that story from getting out. It doesn't matter because it's still a campaign finance violation. You kind of put out $130,000 as a benefit to a campaign. You got to report that. And the heart of this case is actually Mr. David Pecker's testimony. and the paper trail they have showing all of this catch and kill kind of little scheme, which was a benefit to Donald Trump's presidential campaign that was unreported under campaign finance laws. And whether you believe Stormy Daniels or not is irrelevant, because he's not disputing that $130,000 went out the door from him. So it's really interesting. And the prosecution has really put together a very smart case. It's not just about some misdemeanor with Stormy Daniels. It's about violating campaign finance laws, which are felonies.
Does Donald Trump need new lawyers? Robert, I don't know if you're available right now, but Juan Merchan, the judge, made it pretty clear that they're not doing their job very well, calling for mistrials instead of objecting in real time to witnesses like Stormy Daniels. Are they doing a disservice to Donald Trump?
Well, they most certainly are, but I think that's just part of a silly tactic. Everybody knows you object at the time the testimony comes out to allow a judge to take corrective action. If you want to make a drama out of the mistrial theme, because this is Donald Trump's political theme, it's a witch hunt, it's bad, it should be a mistrial, blah, blah, blah. Well, then you hold off doing your proper objections and then object and ask for a mistrial, because, you know, asking for a mistrial is way more sexy than just giving some objection during testimony. So I just think it's just part of the show, to be honest with you. The quality of his lawyering, well, that's an open question. Donald Trump is an impossible client. I mean, reports that you get is he's angry with his lawyers for not being aggressive enough. I think that's just silly, and his lawyers wouldn't be serving him if they were. So does he need new lawyers? I don't know. I'm not sure I'd be available for him. So.
Well, we got that cleared up then.
Well, as we speak, Robert, and our audience on Bloomberg Television could see Donald Trump is actually outside the courthouse right now addressing the media, appears to be reading some papers and holding them up for the cameras to see. Of course, if he says anything relevant, we will bring that to our television and radio audience. And once trial proceedings wrap up for today, Robert, come Monday, we understand Michael Cohen will be on the stand. He has been pegged, or at least described, as the prosecution's star witness. Considering what we saw, though, in the defense's cross-examination of Stormy Daniels, and knowing there are questions around the credibility of Michael Cohen, given, for example, he spent time in jail, how difficult is it going to be for the prosecution and for the defense to deal with him as a witness?
Well, it's interesting. Michael Cohen, I believe, is a much more important witness to the actual crime than, for instance, Stormy Daniels is. But he's also pretty much an open book. We know exactly what he's going to say, and we know exactly what they're going to do to try to attack him. And he's got a pretty good public narrative about he kind of had an epiphany about his role in helping Donald Trump, and he has gone ahead and presented that. Now, it's interesting, though, because what the prosecutor has done is put a whole series of other witnesses, including Hope Hicks, to lay the foundation for what Michael Cohen says. Not the foundation for what Stormy Daniels has testified, but for what Michael Cohen says. So even if they attack him, well, I'm sorry, these payments are still going out the door, and Michael Cohen was facilitating them. And that is the crime here. So, you know, can the prosecution win points? Yes. Can the defense attack them? Certainly. But I'll give an example. There are cases, large drug conspiracies that go to trial all the time with very ugly cooperating witnesses who the jury dislikes, who are not nice people, but they believe them perfectly fine when they point the finger at other co-defendants, and there are convictions that happen that way all the time. So the jury doesn't have to like Michael Cohen. They might think he's a total scumbag, but that doesn't mean they're not going to believe his testimony about what occurred here.
Our last moment here, Robert, the prosecution says it will rest next week. Does that mean we're on time?
Oh, yes. In fact, I had predicted this case would go quickly because, one, it's a very good prosecution. Two, this is a good judge. He knows his stuff, and he doesn't waste time. I'm not sure also how much more the defense has got to say. I mean, what are they going to put on after this? So I think this trial is going to be done certainly well, I would be shocked if this trial isn't done before the end of this month.
There you have it. You've been consistent on that, Robert, and we appreciate that. He's the one who said it would be done in fewer than 6 to 8 weeks. Robert McWhirter, criminal constitutional law attorney. Thank you, as always, for coming back to talk to us, Robert. Next week, Kaylee, could be something else with Michael Cohen at last on the stand.
Yeah, we've been long waiting for it. Who knows how many days of testimony we could see from him. Again, we saw 2 full days from Stormy Daniels effectively. But if the prosecution thinks they're going to be done by the end of next week and they're going to have Wednesday off, potentially Friday too, for Barron Trump's graduation, we could be getting close to the end game here.
This is true. We'll stay in touch with Robert McWhirter on this story for you. We're going to assemble our panel next. Rick Davis and Jeannie Shanzano with us on the fastest show in politics. Thanks for being with us on Bloomberg TV and radio.
Morning from our world headquarters in New York, I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that shortly.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. The stock market running out of steam on this Friday. We are on track for another winning week, 3 in a row. But right now, we are looking at the S&P little changed, up by about half a point right now, up less than 0.1%. We've got the Dow up 79, up 0.2%. NASDAQ right now lower by 30 points, a decline for NASDAQ of 0.2%. 10-year 4.50% with a 2-year that's now yielding 4.86%. Spot gold up $21 the ounce to $23.68, a gain of 0.9%. And West Texas Intermediate crude in the red down 1.2%, 78.27 for a barrel of WTI. Novavax shares are surging after the company signed a $1.2 billion licensing agreement with Sanofi that includes commercializing a combined COVID-19 and flu shot. Novavax up now by 100%. First day of trading for Zeekr Intelligent Technology Holding, the high-end electric car brand under Zhejiang Geely Holding Group. That stock went out at $26 a share right now, $27.20 on shares of Zeekr. Again, recapping, we're looking at a mixed Friday here. The Dow, the S&P, they're both higher. NASDAQ in the red right now, down by about 0.2%. Balance of power continues now. Back we go to Washington. And once again, your hosts, Kaylee Lines and Joe Matthew.
All right, Charlie Pellet up in New York. Thank you. I am Kaylee Lines alongside Joe Matthew here in Washington, where things might be getting a little noisier in terms of jet noise, at least at Ronald Reagan National Airport.
No.
Because guess what, Joe? For all of the talk around maybe forcing an amendment vote to make sure that no extra flights were added out of DCA and the best efforts of the senators of neighboring states, Virginia and Maryland, the Senate passed the FAA reauthorization last night, and guess what?
All the flights are in there. So I'll keep waking up when the airplanes start taking off every day, unless that becomes an earlier call next door to National Airport, where I happen to reside. I'm just wondering, the hour I spent on the tarmac last weekend waiting for a gate, does that get longer or shorter because of this?
Well, the senators from Virginia and Maryland were arguing that it would make delays.
They sure did.
Delayed.
Tim Kaine.
And cause safety issues,
Mark
too,
Warner.
is what they said.
That's correct.
Van Hollen,
not
pardon.
happy. That's right. Look, we've had a series of, close calls on the runways here, the tarmac. I don't have to go through, wheels are falling off airplanes, but we're going to add more flights at National. Let's do it.
Can't wait. It's going to be fun.
Is our panel here? Rick Davis knows about this. So does Jeannie Shanzano. Bloomberg Politics contributors, they actually get something done on the Senate. Although, Rick, I have to ask you about this. You used to deal with these flights with John McCain, right? Getting out of National Airport. Didn't you guys widen the perimeter, the radius on this thing? Should these flights be added or what?
Yeah, John McCain was under enormous pressure when he was a Commerce chairman to add flights, and he did. And one of them actually went to Arizona, and prior to that, you had to take
this
connection. And John McCain, to his credit, never took the direct flight after having approved it. So he didn't want people to think he was doing it out of self-interest. And kind of the opposite of the Virginia delegation you were just mentioning, who out of their own self-interest said no more new flights. So the bottom line is it's going to get more congested at National Airport. Shock and surprise.
Yep.
I just have to say, as someone who has lived in both Washington and New York, I would take Reagan National Airport over LaGuardia, JFK, or Newark basically any day of the week. Jeannie, I don't know if you agree with me on that one, but it's also worth noting that the Senate has passed this, new flights included, yes, but now that the Senate's done this, and the House just has to pass it next to make sure this thing is reauthorized for the next 5 years, did we just see effectively all major legislative work wrapped up for the 118th Congress?
We did. First of all, Kaylee, I couldn't agree more. All of those people who live around LaGuardia, JFK, they feel your coming pain, but, they felt it for a long time up here. I think so. It's getting noisier in the skies over D.C., but quieter in Congress, as they say, because this is probably the last big bill to go out. I mean, we will, some movement on the farm bill, of course, and thinking about potentially the issue of the budget for next year, at least by far as extending the deadline beyond the election. But, that's pretty much it. And I think, you do have some people in Congress who are sad about that prospect because there's other things they wanted to get done. And of course, it is sort of, the coming end of one of the most historic Congresses in not such a great way in terms of the number of bills they've been able to pass. So, between the speaker fights, the lack of bills, it has been quite a historic Congress, and not for great reasons.
Well, saw a lot of important things happen this week, including the attempted ouster of the Speaker of the House. And Mike Johnson has been talking about this, sat down with Politico, Rick, to talk about the experience and what he thinks might follow it, remembering that he was saved in part with the help of Democrats. Here's Mike Johnson in his conversation with Politico.
Look, we have a job to do here. We have to govern. I'm glad that was done. Let's rip the Band-Aid off and get it done. I regret that it had to come to that. I spent a lot of time talking with Thomas Massie and Marjorie Taylor Greene and even Paul Gosar about it. It's the way I operate.
And now apparently he says he actually spoke with Marjorie Taylor Greene, Tom Massie, Rick, as soon as they got off the floor following this motion to vacate vote. Does Mike Johnson try to rebuild the Republican conference or just walk with the help of Democrats from here?
There's so much anxiety now within the Republican caucus, and this latest attempt by Marjorie Taylor Greene to top of the leadership has only exasperated this. These people really dislike each other. There's no putting Humpty Dumpty back together again in this caucus. And in so much as they're going to make it to Election Day, and if Republicans win the majority in the House, they're going to have to really look inside and say, how are we going to manage this? Whether there's one majority leader, one vote that gets them into majority, or if it's 10, they still have a massive split in their caucus. And so I think it's really going to be incumbent upon Johnson just to keep the boat afloat between now and Election Day. Don't cause any more consternation than you have to. And I'm sure he was telling those members who tried to oust him, like, can we just focus on the elections and not focus on, your sort of party tricks that make you get more clicks in your in social media, and let's just get down to the business of governing. So there is a frustration within the Republican Party with each other, much more so than with the Democrats, which I think was reflected in this interview where he talks about Hakeem Jeffries in a very glowing terms, unlike how he talks about some of his own Republican caucus members.
Yeah, it's pretty remarkable to hear the not reverent, but at least kind language for some of the Democrats in this interview, Jeannie. But as Rick was just talking about how Mike Johnson was probably to all of his colleagues, look, you just need to focus on the campaign. It is, after all, an election year. And right now, the prevailing thinking is that the House is more likely to flip back to the Democrats than to stay in Republican hands, just given the map, given to what you were speaking to earlier, Jeannie, the dysfunction, the general lack of legislative work that has been done over the last year and a half. If they don't do much going forward, can they do anything to change that status quo assumption, to change the mind of the opinion of this Republican-led House of Representatives?
Yeah, I don't think they can change the view people have of the dysfunction that has been the House. That's why they all want to get out of there, get back to their districts, and do something that our representatives do quite well across the board, which is serve constituents. That's why they have really high reelection rates. I think it's going to be a close election. I have to tell you, I was struck by the fact in that interview that Mike Johnson, is hearkening back to, Tip O'Neill, Ronald Reagan. He wants a time in Washington that no longer exists. And I'm worried about him, quite frankly, because he didn't pay as much lip service to Donald Trump as he may need to retain his position should they win. Like when they asked him about the issue of Jack Smith, he was like, yeah, no, nothing we can do. We're not going to go for that. So, I think there's some real questions here. And since Rick likes to read truths now, we know that Donald Trump has been speaking to that. And the video that was out there, him saying he just loves Marjorie Taylor Greene. So if I was Mike Johnson, I would hug Donald Trump a little closer if he wants to keep this job going forward, whether as Speaker or Minority Leader.
Wow. Well, I'll tell you what, I have hope, Rick and Jeannie and Kaylee, who, by the way, interviewed Senator Raphael Warnock earlier this week. It is a very important announcement this morning, and I'll bet you Rick has memories of this. Raphael Warnock, Democrat from Georgia, and Senator Bill Cassidy, Republican from Louisiana, of course, are going to be national co-chairs of National Seersucker Day. And that's, of course, a big deal in the U.S. Senate. The 11th annual, Rick, it'll be celebrated June 13th. It's things like Seersucker Day and the great Senate tradition. that keep the gears turning in Washington. Am I wrong?
I'm trying to choose between my pink pinstripe seersucker or my blue pinstripe seersucker, but you'll see me in it on Bloomberg.
That's a big promise. Now I have a lot to live up to there. I'm not sure I could pull that off like Rick.
So maybe when Rick is back in the 5 p.m. edition of Balance of Power, we'll have seen an outfit change, perhaps, Rick?
June 13th.
Is that a commitment?
Do I have to respond?
He's pleading the 5th.
Yeah, no, that's okay. You're on the record, Rick. I don't think most Americans knew there was a pink seersucker, actually. We're learning a lot as we go here. I think about the blue and white. Are you with me there?
Yeah, sure.
All right, Rick Davis and Jeannie Shanzano, thank you for humoring us, as always, and for the great analysis. Our signature panel, Bloomberg Politics contributors, June 13. Kaylee, put it on the calendar.
All right, there we go. Indeed, it is on the calendar. We still have a lot on our calendar for this hour.
Yes,
by the way, we have to talk still about geopolitics, as we have seen a big week in news regarding the U.S. and Israel specifically. Dale Buckner, the CEO of Global Guardian, is going to be with us in just a few moments.
Fascinating insights from someone with a lot of experience. And later this hour, Kaylee, our interview with the chief financial officer of Zeekr, the big Chinese IPO today, as we're at the same time reporting the expectation of Joe Biden to potentially quadruple tariffs on Chinese EVs in the next week. This will be a fascinating conversation. We're looking forward to it.
Indeed. First, though, let's get some world and national news now. Amy Morris has that in our 99.1 newsroom here in Washington. Hey, Amy.
Hi, Kaylee. Israel's war cabinet has reportedly signed off on expanding the military operation in Rafah. Khan News is reporting the cabinet renewed the mandate that they had given previously to Israeli negotiators to the ceasefire and hostage release talks. Sources tell Axios the cabinet approved a measured expansion that does not cross President Biden's red line. However, a third source says the expansion may include actions that could be interpreted as crossing a line. The UN says northern Gaza is already in a state of, quote, full-blown famine, so more than 1 million Palestinians sought refuge in Rafah in the south. Now about 110,000 people have fled that city, too, as heavy fighting between Israeli troops and Palestinian militants on the city's outskirts has left aid crossings inaccessible and food and fuel supplies critically low. UN officials warn the lack of fuel is now undermining medical facilities, water supplies, and sewage systems across Gaza. Jurors are gone for the day in Donald Trump's criminal hush money trial in New York. The judge now looking over the schedule. Prosecutors say they only expect to call 2 more witnesses and that they could rest their case by the end of next week. The prosecution's star witness is set to testify on Monday. Former Trump lawyer Michael Cohen is expected to testify about his role in arranging a $130,000 payment back in 2016 to adult film actor Stormy Daniels. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
On season 2 of The Circuit, we're walking with the titans of banking.
Hello! You guys love these meet and greet things.
Me too! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a mixed market on this Friday. The Dow, the S&P, they are both higher. We've got NASDAQ trading lower right now. NASDAQ down 30, drop there of 0.2%. We are on track for another winning week, 3 in a row on the S&P. Little change right now, up by 1 point. That is a gain of less than 0.1%. Dow Industrials up 87, higher by 0.2%. 10-year 4.49%. The 2-year 4.85%. Spot gold up $23 the ounce, up by 1%, and West Texas Intermediate crude oil down 1.2%, 78.28 for a barrel of WTI. Bottom line, stock market losing traction. Bond yields are rising after data this morning pointed to an economy that is slowing. Sweet Green shares are surging after the salad chain increased its annual sales projection and improving profitability as it seeks to expand its footprint. Sweet Green shares, they're up now by 33%. Also keeping an eye on Zeekr Intelligent Technology Holding. That is the high-end electric car brand under Zhejiang Geely Holding Group. First day out went public at 26. Right now it is trading at 27.30 a share. Again, recapping, the Dow, the S&P both higher, NASDAQ lower, S&P right now up by 1 point. Balance of Power continues, the Friday edition. Back we go to Washington once again. Your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie, thanks for that. We'll keep tabs with Charlie and midday trading, of course, on Wall Street, as we do always here on Balance of Power, the fastest show in politics. Alongside Kaylee Lyons, I'm Joe Matthew in Washington, where we are still waiting for word on a potential ceasefire. And now there is an expectation that the State Department will soon submit a report to Congress that could be highly critical about Israel's conduct in Gaza. Kaylee, this is something that is following Joe Biden as president and as a presidential candidate, and got a lot more complex this week. This report could make this more difficult yet.
Absolutely. Of course, we heard from President Biden in his CNN interview earlier this week about the paused shipment of bombs that the U.S. For now has put on hold to Israel. He said these have been used to kill civilians in Gaza. And part of the reason that the U.S. is not sending them, at least at this time, is out of concern of how they may be used against a city in which there is more than 1 million Palestinian civilians currently taking shelter. They're very concerned about Rafah and are, of course, repeatedly warning the Israeli government and the Israeli army not to conduct a massive operation there. But in the face of that, the Prime Minister, Benjamin Netanyahu, is still sounding rather defiant. He had this to say in an interview just yesterday.
I've said in the Holocaust memorial service that we had the other day, I said in the Holocaust we stood alone, but we were defenseless. And today, if Israel has to stand alone, we'll stand alone.
That was on the Dr. Phil program.
Yes.
Kaylee, which is really incredible when you consider the optics there, the audience they were trying to reach. I know they apparently have a long relationship, but that was not by accident.
No, certainly not. And of course, he has also said in his commentary over the last day or so that Israel will fight tooth and nail. If they need to, because they have a fight, of course, that they are looking to finish. We want to get more perspective on this now with Dale Buckner. He is the CEO of Global Guardian. He also is a retired Army colonel. Dale, thanks so much for coming to us here on Balance of Power on Bloomberg TV and radio. When we consider what this Rafah operation ultimately may look like, what difference does the receipt of these U.S. weapons or not ultimately make?
Kaylee, in the short term, I don't think it makes a lot of difference, and here's why. 69% of all of the military support that Israel has comes from the United States. They have a lot of munitions as of right now. So as you think about going in, if the United States was to stop as of this week, sending 2,000 to 3,200 pound bombs, that's the primary thing that's being pulled back. In the short term, it doesn't make much difference. Now, if this goes on for another 6 months, a year, 2 years, and/or the Israelis then turn north and, as discussed previously, start to then escalate towards Lebanon, then it would have a real long-term effect.
We've been hearing about shelling in Rafah. We've been hearing about the IDF controlling the gates on the Egyptian border in Rafah and other operations that have been happening inside the city. Is the invasion of Rafah already underway?
So it is underway. It's very limited. If you look at the map in the southeast corner down near the Rafah gate, so far the IDF has gone in a very limited capacity. Now, as discussed and just recently announced today, the War Cabinet has approved a larger scale operation. That being said, don't expect a massive IDF invasion overnight or in the next few days. You have to understand there's about 4 to 6 battalions of Hamas left. And more importantly, and this is really the key, tactically, the remaining hostages that we believe are alive, and those 4 to 6 battalions are all in a very small area. So as you think about this, this is where precision will matter, and this is where you can expect you're trying to thread the needle, where you're trying to take out and attrit the Hamas fighters that are left. At the same time, the real risk of dropping large munitions is you could start killing Israeli hostages. This is going to be very difficult.
Well, and even if you are trying to be precise, Dale, what we consistently hear about Hamas is that they use women and children as literal human shields, that they specifically have their operations based in areas in which there is a high likelihood of collateral damage. Is there, I guess my real question is there any way that Israel can do this, can take out the remaining battalions without that death toll going higher than the north of 30,000 it already is?
Yeah. I think that you can, on the outskirts and the perimeter of this, you can continue to attrit Hamas, especially if they have good intelligence. Now, where it gets really messy, and make no mistake, war is messy. As precise as it appears to be on video games, that's not the real world. And we've already experienced this now since October 7th. Trying to separate civilians and hostages is almost an impossible task. So to your point, Kaylee, I think that on the perimeter, you can continue to put pressure, ultimately hoping, as you think about the negotiations, we're probably down to 2 or 3 key terms as we look forward to trying to find a ceasefire. This is pressure on the outskirts. As I talked to Joe last time, Netanyahu's been saying for several months now he's going into Rafah, and he hasn't, not at scale. Now it's limited. Now I think you see attacks in the periphery continue to attrit, put pressure diplomatically and from a military standpoint, and ultimately try and find a path to a negotiation while applying limited tactical pressure.
Dale, we've been focused on the South for the balance of this conversation. Are you hearing anything new about Israel moving to the north? And if it does, in fact, decide to make a move on Hezbollah, will it be this type of approach, starting small before going to scale?
Yeah, so if you're watching closely, there's been an escalation in the north. 3 IDF soldiers have now been killed in the last 24 hours. There is increases in attacks, both sides. So yes, as we've talked, Joe, there's a movement afoot. It's limited. And to your point, I do think this starts out in a limited capacity as they figure out, again, you have different agendas being played out. You have a political agenda, you have a humanitarian agenda, a diplomatic agenda. All these things are not aligned right now, and it's going to be very interesting to see what happens next. No one knows when and how, but there has been an escalation on that Lebanese border, and depending on how this pressure in the south and the negotiations go, that will be an indicator of what might be next steps in the north with Lebanon.
Stay tuned to this space for more on that. Dale Buckner, it's great to see you. Dale, thanks for coming back to talk to us. This is the CEO of Global Guardian, a retired Army colonel with experience in the field that matters to his insights here on this. Kaylee, it's really something. We're talking so much about Rafah here. People's eyes aren't on the north, where the real headlines could be coming in the weeks ahead.
Yeah, it's important to keep your eye on the many balls that could potentially be in the air. There is so much potential for surprise in a conflict like this. As we were just hearing from Dale, war is messy. And of course, we've all come to understand just how messy over the course of the 7 months between October 7th and now.
That's for sure. Kaylee, one of the other major stories that we're following here, tariffs that could come as soon as next week, according to Bloomberg's reporting against Chinese goods, including EVs. The Wall Street Journal reporting more specifically, EV tariffs could increase some 4-fold, which would bring them beyond 100%. If you do the math, this could be a major problem in our trade relationship. And Kaylee, that's why the timing of a Chinese EV maker today going public at the NYSE is quite remarkable.
Indeed. Zeekr, of course, debuted trading earlier today after an IPO at $21, trading at about $27 a share. So certainly a positive debut, despite of news that potentially could bring a potential headwind to a company like this.
Well, yeah, that's right. Now that the shares are trading, we're joined by the Chief Financial Officer at Zeekr, Jing Yuan, who's with us live from the New York Stock Exchange right now. Mr. Yuan, welcome to Bloomberg. It's good to see you here. With everything that I just mentioned, the expectations of tariffs rising, particularly on EVs, maybe 4-fold next week, considering our deteriorating economic relationship with China. Is this the worst timed IPO of all time?
Yes, if you think about timing, we at Zeekr never try to time the market or chase the latest trends. I mean, we follow our own strategies. If you think about overall, say for example, overall Chinese EV market, if you read the numbers in the first half of April, in China, the passenger vehicle market records a new energy vehicle penetration rate of more than 50%. If you look at my pipeline, I've introduced my all-new 001 in February this year, and earlier this year, in 1st of January, started delivering my all-new 007. So my pipeline is also very strong. And if you think about my international expansion strategy, we've been starting selling cars to international markets since last October. And sorry. and in this year we're going to sell more cars. So we need this kind of transparency brought by a U.S. listing. All in all, we do think it's a good time. We're not considering about short-time headwinds. We think in long term and trying to make sure that in the long run we make a very, very good business case.
Well, sir, as you talk about how you're expanding to international markets, considering the existing tariffs in place in the United States, the country in which, as of today, you are now listed, and potential that tariffs go even higher, are you now listed in a market that you may never actually be able to enter and be competitive in because of those tariffs?
Yeah, so we are not entering this market, or we are not just listed in the U.S. because we want to enter into U.S. markets. We get listed in the U.S. as mentioned earlier. We're thinking about all the transparencies being the U.S. listed public company, all those securities that I receive, and the comfortable I can provide to global regulators that I am a transparent and basically very good global corporate citizen. We think that is actually more important.
Mr. Yuan, the reality check seems to come in your prospectus here as Zeekr warns investors that the Chinese government could, in fact, intervene in its business to further its own regulatory, political, and societal goals. Sir, why would a U.S. citizen ever invest in a Chinese company right now?
Yeah, so I was thinking about, if you look at the U.S. capital market, it's continued to be a very big, transparent, and probably the most liquid capital market in this world. So being a foreign issuer, we want to see if we can tap this type of markets, and we want to see, we have access to capital at time of needs. Again, it's more about my strategy. It's more about long-term view rather than short-term headwinds.
Well, when we consider that long-term view, something we consistently hear warned about by the U.S. administration, including, say, the Treasury Secretary Janet Yellen, is industrial overcapacity in China, that potentially there's going to be too much supply, not enough demand. In your domestic market, with the rapid production we are seeing of electric vehicles, is there going to be adequate demand for you? What is your view on that situation?
Yeah, so that is something which actually differentiates us from most of my competitors. If you look at my business model, I actually do contract manufacturing, and my contract manufacturer partner is Geely Group. If you look at Geely Group as a whole, we produced 2.8 million cars last year globally. And those production capacities, currently, obviously, most of them are gasoline-powered vehicles, but in the future, it's going to transfer into new energy vehicles, especially EVs. And we are leveraging on that. We are taking that right. That's why, we do think this kind of contract manufacturing arrangement actually helps us to solve these overcapacity issues if, any of the regulators have any concern.
Well, with all of this said, Mr. Yuan,
yes,
you're talking about a new stock here in the United States. We're talking about the increase in tariffs that's looming and a very challenged relationship between our two countries. Can you be honest with our listeners and viewers today? Is an investment in Zeekr an investment in the PRC?
I would say an investment in Zeekr is an investment in a very good business, an international business that have potential to expand into global, right? So we are definitely a Chinese company, but a Chinese company and PRC, government or PRC, is two different things.
How so?
Again, we are a non-state-owned enterprise trying to tap one of the largest capital markets.
But the Chinese government can intervene on your business at any time, correct?
That's a disclosure in my prospectus.
Right. So you had to put that there for a reason.
For disclosure reasons, fine, because if you look at prospectus, lots of other disclosures, force majeure, act of God, etc., etc. We are just trying to make sure the investors are aware of all the potential risk involved, and we're being transparent. That's one of the reasons why I'm trying to list. We have listed in this market.
Mm-hmm.
All right, sir, thank you so much for joining us on this debut day in the U.S. markets. That was Jing Yuan, live from the New York Stock Exchange, the CFO of Zeekr, which debuted today and is trading right now at $27.27 a share, Joe.
You said it. We'll keep tabs on that for you, as well as our continuing coverage of the Chinese government and its relationship with the U.S. Kaylee, I'll meet you back here at 5. You know what that means. Bloomberg Business Week starts right now.
in recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody, live on radio, TV, YouTube, Bloomberg Originals. This is Bloomberg Business Week. Carol Masser along with Tim Stenivek at TGIF. It's been a busy week for all of us.
It has. Week's not over yet, Carol.
No.
We got a couple hours left in the trade today. We got 3 hours left in our total program of Bloomberg Business Week, and it's going to be a good one.
Yeah, it is going to be a good one. And we're going to talk a little bit about the markets because we've seen a different momentum play, if you will, this week and really for the month overall, although tempering back a little bit, I feel like. So we're going to get into that. There is a reason why it has to do with inflationary expectations, so we'll dig into that in just a moment.
Hey, also top of mind for us this hour, we're going to do a big theme for the hour, and it all has to do with China. An EV IPO out of China now trading in the U.S. Also, President Biden getting ready to ramp up tariffs on Chinese EVs. And then, Carol, investing in China through an American lens. We're going to have the founder of Core Values Alpha here with us.
I think it's fair to say there's a bit of a debate when it comes to whether or not China is investable, but we're going to get into that. And we're also going to get checked, too, on those market trends. Options Insight with Abigail Doolittle. She's going to give us the setup on this Friday, but also dig a little bit later into what the options market is telling us, specifically, Tim, when it comes to gold.
Can I just say welcome back to Carol Masser? 4 days in California, back here in New York for Bloomberg Business Week.
It was a lot of fun. We got some great interviews, some great insight, and then really fun to spend Bloomberg Technology with you in San Francisco. That was such a great deep dive into AI and so much more.
Yeah, it's all going to inform our coverage over the next hour and the next 3 hours as well. Before we get to all that, though, here's an update on the day's top business stories and also what's going on in the markets. Here's Charlie Pellet.
Thank you very much. And again, big warm welcome back to both of you. Reunited feels so good. Good for the Bulls today. On track for another winning week. 3 in a row for the S&P 500 index. Right now we're higher. We've got the S&P up 3. Gain there of just about 0.1%. Little change, perhaps the key takeaway on the S&P. Dow Industrials up 84 right now, up 0.2%. And NASDAQ lower by 19, drop there of 0.1%. 10-year 4.50% with a 2-year 4.86%. Spot gold up $23 the ounce, higher now now by just about 1%. Spot gold, $23.69 the ounce, and West Texas Intermediate crude down 1.2%, $78.31 a barrel. Keeping an eye on Zeekr Intelligent Technology Holding. That is the high-end electric car brand under Zhejiang Geely Holding Group. ADRs are higher after an expanded IPO. Went out this morning at $26 a share. Right now, we've got Zeekr trading at 27.3%. That is an advance right now of 30.1%. Again, recapping, the Dow, the S&P, they're both higher. We've got NASDAQ in the red right now, lower a little changed. S&P higher a little changed, up 4 points, up under 0.1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. Good to be back at Bloomberg headquarters in New York City. Having said that, stocks, yeah, they're kind of up, but it feels a little bit more strained in terms of the upward momentum that we've seen. We have seen a bullish, I should say, month here in May. And I will say that it's a little bit being pulled back or restrained today because particularly we got a U.S. consumer sentiment report. It declined in early May to a 6-month low as short-term inflation expectations and concerns about the job market picked up. So that's, I would say, Tim, safe to say worrying equity investors a little bit today.
It is, but look at the overall trend for the last 3 weeks. And that's a question I'm going to pose to Abigail Doolittle. She's Chief Markets Correspondent here at Bloomberg News. She joins us here in the Bloomberg studios. Abigail, how do you look at a day like today in the context of what we've seen over the last 3 weeks? Because the bulls have been in charge.
They have been in charge over the last 3 weeks. Not a lot going on right now. These bulls and bears just battling it out. And I think everybody's tired. I mean, and welcome back to both of you.
Hey, present company included.
Preach it to the choir.
Speaking of, I can only imagine for the both of you. But I think that everybody's tired because, this is an interesting stat. So if we go back to the beginning of earnings season when J.P. Morgan reported stocks, the S&P 500 basically flat. But during that time, the S&P 500 down about 5% and now back higher, not quite at the all-time highs, but back above 5,200. If the index can hold 5,200 on the close today, that would be a potentially positive sign for the bulls. That said, I'm looking at the chart right now, and when we gapped higher off of the FOMC statement and Fed Chair Jay Powell's commentary, it appears as though that gap may fill. If that happens, then you're going to hear everybody talking about a somewhat wonky technical term, which is a double top. As you can imagine, it's two spikes up in the market, and then once you go below the low, it makes an equal and opposite measure to the downside. We don't know that that's going to happen, but that possibility is setting up right now. But if we're above 5,200, hey, the bulls may take it. The minute we go back below 5,200, I would expect it to be a pretty fast slide back down toward the recent lows of, let's see, what was it, 49.50, and then closer to that 46, now 4,700, that 200-day moving average.
Wait, so is it a 50-50 of, it could go continue to the upside,
let
or 50-50
me pull up,
continue to the downside?
Let me get the crystal ball going here.
You actually do have a crystal ball. It's called charts.
Because I feel like you've been I don't want to say negative, but more to that, there's more downward sign.
Yeah, I mean, even when I look at it now without pulling up other indicators, it looks like you have the bears, the sellers are latent. They're just really waiting to pounce. And so there's kind of some of the recent, basically the Fed meeting. So you have the RSI close to bought again, but it's still in this series from last December of lower highs. So we once again have a bearish divergence, the one that I've been talking about all year, where these highs are made on less momentum. So my thought would be that we probably will see the sellers strike when they can, whether it's CPI, whatever the piece of news is that they can use. They're going to push.
NVIDIA earnings coming our way.
Yes, they're going to push really hard. Now yields, this is a really interesting one to put into the picture, because today, of course, we have the 2-year yield up about 6 basis points, or 5. The 10-year yield is up about the same. And this, of course, after the big slide post FOMC, investors encouraged by the idea that Fed Chair Jay Powell said that they're not going to be hiking. Now, that said, I'm looking at this 2-year yield right now. It's holding a perfect trend line up out of the January lows, suggesting it's setting up to shoot higher, and not just shoot higher, but shoot above 5%. If this yield goes, I think that we are actually possibly setting up for a case scenario similar to what Jamie Dimon has talked about, which is 8% on interest rates. I don't know if we make it quite there, but there's there's something brewing in these charts that suggests to me that we could shoot higher.
Just one last quick thing. It was really fascinating to be out at Milken, and one of the things that kept coming up, and one guest in particular talking about the inverted yield curve that we have had for a very, very long time. And it was interesting how I feel like we haven't all been talking
forgotten about it, basically.
Exactly. But the significance of that, and they thought that's an important indicator that we cannot forget about.
Yeah, I would absolutely agree with that. And I think that same guest, possibly from Carlisle, was also talking about higher for longer, but not because of inflation, but because of supply, that there may not be the buyers for yields. And this chart of the 2-year yield, that's actually what it matches. It doesn't match the Fed or inflation, unless it was monster inflation. It matches something, actually, I would say, a little bit more systemic. Now, this is early on. It's not confirmed, but I'm seeing it. I'm like, wow, this might come to play at some point this year, next year.
Yeah.
I got to go back a second.
Okay.
Did you say 8% rates?
Jamie Dimon did. And Jamie Dimon said about 2 or 3 weeks ago, and he's called for 6, 7, and 8, and like they kind of follow and lag.
But he's not necessarily saying that's going to happen. He's saying we're prepared for that
the
range.
Possibility.
The possibility.
I mean, but even his saying that, and that is what these charts are saying. So Jamie Dimon and the charts are actually saying the same thing. The range, it may not happen. We may stay exactly where we are. In fact, there's a good possibility. Actually, I wouldn't say it's a good possibility. I would say it's a possibility that we go back lower. The reason that this 2-year yield looks like it's going to shoot higher, if we go back to 2022, its low level that I'm looking at in terms of this formation, it's called basically a triangle. It looks like a triangle. It's right below 3%. Then the next low on the Silicon Valley banking crisis was right below 4%, and then right above 4% last year. And then you have an equidistant top. It creates this congestion, this coil where the sellers just take over and sell treasuries and yields go higher. It's basically an equal and opposite move from 3% to 5%. So let's call it 7%.
Okay.
This chart's just 7%, not 8%.
If we go back to the April letter, he talked about a range from 2% all the way up to 8%, or even more, he said. So, yes.
That's quite a range.
That's quite a range, yeah. And above 8%, I mean, listen, you can look at a chart. It's like a discount rate. You can make it say what you want to say. But I'm going to say fairly, there's a very good chance we see 7% over the next 12 months.
And I would say that there's a fair amount of macro factors out there that could ultimately, when it comes to inflationary expectations or pressures, that could stay out there or maybe spike at any moment. So maybe that's some of the thing. That's your setup. Abigail, thank you so much. You're going to be back a little bit later.
Yeah, I was going to say, don't go too far, Abigail, because you're going to be back with us in just a little bit.
All right, folks, that is your market setup. We've got just under 2 hours to go until we ring the closing bell on this Friday and wrap up the trading week. We do want to get to one of the macro factors that investors continue to keep on their radar. And it is actually one of the most read stories on the Bloomberg today. It is a Bloomberg exclusive. President Joe Biden's administration, you heard our Balance of Power team talking about that. President Biden's administration poised to unveil a sweeping decision on China tariffs as soon as next week. This is according to those familiar. One that is expected to target key strategic sectors with new levels while rejecting the across-the-board hike sought by Donald Trump. This is according, again, to folks familiar. We're talking also about EVs.
Yeah, here with the details, we got Bloomberg News economic reporter Eric Barton joining us from Washington, D.C. So, Eric, Bloomberg had the story exclusively this morning. You are on that byline, and then we get a bit more on the particulars from a Wall Street Journal story that came a little later. What exactly do we know right now? What do we need to know?
Sure. What we're hearing from our sources is that this announcement could come as early as next week. We've heard from a couple of people that it is currently scheduled for Tuesday, although this is something that is really several years in the making and has been something that's continually been pushed back. So, there's always a possibility with the politics involved, the sensitivity of the U.S.-China relationship, that this could slip. But this is the result of a culmination of a review of almost a couple of years, a 4-year review of these tariffs that were first applied by President Trump starting in 2018. And they apply to more than $300 billion of annual imports from China, $300 billion. So talking about a huge amount, a big part of the trade relationship. Biden administration trying to make them more strategic, keying in on electric vehicles, on batteries, on solar cells, and trying to be more strategic and better leveraged about the kind of pressure they're putting on China to change what they see as unfair behavior and unfair subsidy and promotion of the manufacturing industry there.
Well, that's what I wanted to get to, Eric. What's the policy justification on the part of the Biden administration to take this move against China?
Well, these tariffs were originally put in place with the identification of intellectual property theft and as a way to try to get China to stop doing that. Both administrations saying that American producers can compete, but that they need a level playing field. We've seen this afternoon from the Wall Street Journal a report that the electric vehicle tariff increase that we reported on last night is going to be as much as a quadrupling. In other words, going from 25% to 100% tariffs, which is a big number and a big increase. But listen, I used to live in Mexico City. If you're in Mexico and you see BYD vehicles selling for $12,000 there and Teslas starting at $45,000 in the U.S., there still is a question about how do American EVs compete and how do European vehicles, for that matter, that are also having tariffs imposed. Europe has imposed tariffs on Chinese vehicles. How do they compete against this overcapacity and overproduction in the Chinese vehicle market that's done via state sponsorship?
So, Eric, it raises the question about the efficacy of tariffs like these. We've seen past administrations, the Trump administration do this. We saw the George W. Bush administration use tariffs as well. Economic impact here, to what extent do these actually work in terms of getting goals accomplished?
Well, what we have seen certainly with the Trump tariffs was a decrease in the tariff categories, the tariff lines of goods that face the increased duties in the previous administration. And so we've seen, a great deal of effect in terms of impacting those goods. Big question, though, is who is paying that cost? There are a lot of American manufacturers who say, hey, we've got intermediate goods that we get from China, inputs to our finished manufactured goods that are more expensive for us, hard for us to compete against manufacturers in other countries that are not having to face these tariffs on their inputs. And then a question ultimately, which has been one that the U.S. Treasury Department at some point in these deliberations focused on, which is what is the cost for American consumers? And that's one of the reasons this decision was delayed, was the concerns about inflation a couple of years ago.
Well, I do wonder, less competition, right? You do wonder what that means ultimately for all of us in terms of buying these products. Having said that, I get, some of the pushback by the Biden administration, but I got to ask you, the Biden administration increasingly getting involved with, various industries here in the United States, maybe not state-sponsored entities, but you see certainly the support, whether it's EV tax credits. You also see the support for the semiconductor industry. So it's very interesting to see some of the policies that we are taking yet kind of pushing back against other countries and China in particular.
Absolutely. One of the hallmarks of this administration has been the pursuit of industrial policy. It's something that the U.S. has not done very well in the past, has sometimes shied away from or failed at, and yet we are seeing things like the Inflation Reduction Act, like Chips for America, trying to identify areas where the U.S. and the private sector could use a boost or an impetus from the government, and seeing the administration taking a leading role in that to try to better compete with China after decades when the feeling was that China was really out-competing the U.S. through state sponsorship.
Hey, I'm wondering, Eric, look, it's not necessarily a story about voters and a story about the election, but we're in an election year, and I'm wondering what your reporting tells you about the way that this could move the needle when it comes to November. Do voters care about this stuff?
Absolutely. The election politics are one key here. Obviously, we've seen polls identifying inflation as a big issue, as well as concern about immigration. But as we saw in 2016, trade is a sensitive issue. This is something manufacturing states often are swing states. We've seen that in the case of Pennsylvania, Michigan, Wisconsin. And so definitely an aspect of this trying to appeal to organized labor, trying to appeal to blue-collar workers, manufacturing workers, and say, we've got your back and we're going to help to protect some of those industries against unfair competition from China.
Hey, Eric, if it doesn't happen here, but it sounds like it is, should we assume no matter what happens in terms of the November election, be it Biden or Trump back in the White House, that they're going to continue to pursue a tough policy, trade policy against China?
Absolutely. That is one of the few things that I think most people would say both parties here in Washington agree on, is that the U.S. needs to be tough on China, stand up to China. We've seen former President Trump talking about 60% tariffs on China. So really a race between Presidents Trump and Biden about who can be tougher and who can stand up stronger against China in that trade relationship.
All right, going to leave it on that note. Listen, great to check in with you. And as we said, this story exclusively being reported by Bloomberg earlier today. Eric Martin, part of that team, putting that out there. He is economic reporter at Bloomberg News, joining us from Washington, D.C. Eric, thank you.
Hey, taking a look at the markets right now, we're seeing a little bit of red and a little bit of green on the screen. The S&P 500 higher by a little more than 0.1%. The NASDAQ just down fractionally, while the Dow up 100 points. That's 0.3% to the upside.
Yeah, we talk about macro factors and certainly trade policy, geopolitics, all of this comes into play. We're going to continue digging into this in this hour. But coming up next, we're going to dig a little bit deeper into an IPO, Chinese EV. You know it. We're talking about Zeekr. That is coming up next on Bloomberg Radio and television. This is Bloomberg Business Week. Carol Massar, Tim Stedovic. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall? That's a great question.
I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index on track for another winning week, 3 in a row. Right now, we've got the S&P higher by 0.1% on the week, up by 1.8%. Stock market, though, losing traction. Bond yields rising after data pointed to an economy that is slowing amid stubborn inflationary pressures. S&P again up 5, up by 0.1%. Dow Industrials up 89. That is a gain of 0.2%. NASDAQ trading lower. We've got NASDAQ down 10, a drop there of 0.1%. 10-year yield 4.50%. The 2-year 4.86%. Spot gold up $22 the ounce to $23.69, up now by 1%. On a retreat for crude oil today, down 1%, $78.41 a barrel on WTI. Ford has promoted Chief Financial Officer John Lawler to Vice Chair to oversee the automaker's long-term strategy. Ford also hired Sherry House, the former CFO of EV startup Lucid Motors, as Vice President of Finance. Ford shares down 1%. Zeekr Intelligent Technology Holding, that is the high-end electric car brand under Zhejiang Geely Holding Group, higher, went out this morning, $26 a share, right now advancing to $27.88, up by 32.7%. Recapping, S&P higher by 6, up 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, just to reiterate, Charlie's been talking about it. We all have. As Tim mentioned, ticker ZK, it's definitely on our minds today. We said we've got a theme of China this hour, and we're going to continue with that. Shares of Zeekr Intelligent Technology Holding, the high-end electric car brand under Geely Holding Group, rising as much as 40% after an expanded initial public offering. That's the biggest U.S. listing by a China-based company since 2021, and we're looking at Zeekr up right now, Tim, just shy of 33%.
Okay, so let's get to our roundtable because we got a great one. We got Amy Orr with us. She's Bloomberg News equity capital markets reporter. You know, when we see her in our studio, we're talking IPOs.
It hasn't happened a lot in the last year or so.
But she's been busy with this one. Also with us is Bloomberg Intelligence Global Autos and Industrials Research Analyst Steve Mann. Steve, I do want to start with you because it's an IPO, but it's also a story about the auto industry, and especially comes at a really interesting time, given that demand for electric vehicles, especially here in the U.S., but also globally, is not what a lot of investors and a lot of analysts thought it would be in 2024. Talk to us about the timing of this company coming to market against these headwinds.
Yeah, it is very interesting. If you look at NIO, XPeng, Li Auto, all three are Chinese automakers listed in the U.S. They've been down 27 to 45% year to date. So the timing doesn't seem as very timely, but I think globally auto sales are down, especially in Europe, in the U.S., but the Chinese are still doing okay. In the last couple of months, sales have gone up, and I think Zeekr, I don't think I have plans to sell in the U.S., maybe in Europe, but this is going to help build brand cachet for the brand locally in their home market.
All right, we're going to dig into that a little bit more because it sounds like they're gunning for Tesla because it's a little bit more of a higher end play. But hang on for a second. I do want to bring in Amy Orr, who follows the IPO market for us. Amy, as we mentioned, out of the gate, strong showing. How would you characterize this? And get into that Geely has indicated that it is going to subscribe to more than 90% of the stock. So they're going to own a lot of it, it sounds. So put it all in perspective.
So which is good to actually provide a good base and foundation for the stock to go up at a time when, like Steve was mentioning, that EV is not actually particularly kind of doing well across the board.
But does it show that Geely was a little, am I saying it right too? We had some debate. Geely. Okay. We want to make sure we've got it correct because there was a little bit of a debate in the newsroom. But is it a sign too that Geely was a little concerned about maybe the interest amid kind of the broader EV backdrop?
To be honest, I would say that just IPOs as a whole has been kind of choppy, and then particularly EV. And then given that at the time of the pricing, it was only 5.2 billion in market cap, and then now it's went up to around 7 billion or so.
But not the 13 billion they were talking about a year or so ago.
Definitely far away from that. I'm sure there were conservatism right there just to make sure that there is a good base, that it was not like 3 or even below. So definitely there is a bit of that, and probably also Geely wants to continue to hold a little little bit more of that, looking at the future growth of the company, especially we're talking about this is the high-end side of the market. It's not the mass market that we've seen. Bloomberg has reported before that there were some headwinds there as well. So yeah, and how to go beyond the Europe market and beyond the Chinese market, going to Europe and other places as well.
So Steve, talk a little bit about that, because it's kind of the perfect segue to what you cover as Bloomberg Intelligence Global Autos and Industrial Research Analyst. What exactly are the vehicles that are being offered? Carol did allude to the idea that they do compete with Tesla, but paint a picture of this company for a lot of people, I think, listening and watching right now, who have probably never before today heard of this company.
Yeah, Zeekr is born out of Geely. It's the parent company, Zhejiang Geely. It's related to the 175 HK that's listed in Hong Kong. I mean, they offer two vehicles right now. One is an SUV, one is a sedan. It's a pure battery EV. It's selling at around 37 to 40,000 US dollar in China. That's about the same price as the Model 3 and Model Y over there. I think what's really unique about Zeekr and a lot of the Chinese brands over there is they're all considered smart cars.
Okay.
With great connectivity, apps that resonate with consumers. Very different consumer base over there. So I think they're going to try to export that type of offering to the globe, and I think listing the shares here, it's gonna help bring the brand cachet not only in China, but it's gonna get the name out there on a global basis.
Hey Steve, people hear Geely and they think, I think, Volvo here in the U.S. Then maybe they hear Volvo, they think Polestar, which is, an EV that is sold here in the U.S., a pretty high-performing one.
I was in a Polestar out on the West Coast.
They're pretty cool.
Yeah.
What's the Polestar relationship with Zeekr? Like, can we think about it like a corollary?
Yeah, that's a good question. I think a lot of the design cues, that's in the Zeekr. A lot of technology within the Zeekr brand, EV brand, it's actually shared between Geely, between Polestar, and Volvo. And there's actually another brand called Lynk & Co. That's it's not available elsewhere, only in China. And so all those companies are actually related. Zeekr's R&D headquarters actually is in Gothenburg, Sweden.
Hey, listen, one more in the company, and then I want to go back to Amy, but I do think about the Chinese EV market. How crowded, Steve, is it getting?
Oh, it's very crowded. It's a hyper-competitive market. As you probably heard, deep discounting's been happening in the last year and a half. And it's interesting because the auto industry, the EV makers, the Chinese EV makers are very much vertically integrated over there. So they mine the lithium, they make the batteries, and then as well as the software. Quite different than how it works here. And I think in the earlier segment, you talked about tariffs in the U.S. And it's really necessary that the U.S. put these policies in place, because to compete effectively with the Chinese, the auto industry needs to be much more vertically integrated. The supply chain needs to be much more vertically integrated than it is now. To really compete effectively with the Chinese.
Really important. You mentioned the price cuts, though. China's best-selling car maker, BYD, slashing prices across much of its lineup this year. So that is certainly the backdrop there. Amy, come on back in. An IPO market out at Milken. We talked with the M&A guys. They think it's starting to come a little bit more activity. The significance of this one actually doing well out of the gate. Is it something particular that it's Chinese, that it's an EV maker, or is it just kind of good to just see an issue come out and actually do well in its first day of trading?
Definitely, we just want any IPO to trade well at this point, I kind of feel. But then, as a Chinese IPO, I would say that the biggest hurdle is not for a Chinese company to actually do well. It's really about whether Chinese government is going to really release the kind of flood of Chinese companies waiting to actually get listed here. And
is there a lot just waiting?
Definitely. And essentially, Chinese companies used to actually form the bulk of, U.S. U.S. listings as well. And also the fact that I think Reuters, if I remember correctly, reported this earlier this morning that Shein is actually going for London as well. So essentially these are the kind of headwinds, political headwinds that we're feeling that is going to hamper the kind of Chinese companies coming to the U.S.
So what are you watching in the next few weeks, in the next few months, as an indication from the Chinese government, from the way that investors receive Zeekr, that might indicate that we could see more IPOs from China-listed companies?
As Steve mentioned, that this company technically is not headquartered in China, but it's got very strong ties with China, that we always kind of see it as a Chinese company per se. But there are also quite a few, like I think Shein is in the same bucket as well, ByteDance in the same bucket as well, that they're headquartered elsewhere, but then we generally just see them as Chinese companies. But I don't feel that there is a floodgate being opened. Right now it's still kind of, trickle. It's on a case-by-case basis.
Hey, Steve, just 25 seconds here. Joe Matthew tried to push the official over at Zeekr about Chinese government involvement in this company, in Zeekr. What do we know? And forgive me, just got about 25 seconds.
Yeah, it's actually a private company, Geely. So, I mean, there's Chinese government's always giving subsidies. So, there are some
out there at our Bloomberg Intelligence headquarters in Princeton, New Jersey. Steve is Global Autos and Industrials Research Analyst. And then right here in our studio are Amy Orr, Equity Capital Markets Reporter, as we said, watching the IPO market. This, as we see, Zeekr shares, they're up, Tim, roughly about 33% off their highs, but still holding on to a lot of those gains.
Okay, from an Amy in New York to an Amy in Washington, D.C. now. Check the latest world and national news with Amy Morris in the Bloomberg 99.1 newsroom in D.C. Hey, Amy.
All right, thank you, Tim. Israel's war cabinet has reportedly signed off on expanding the military operation in Rafah. Sources tell Axios the cabinet approved a measured expansion. It doesn't cross President Biden's red line. However, a third source says the expansion may include actions that could be interpreted as crossing a red line. About 110,000 people have fled the city of Rafah in anticipation of an expansion of fighting between Israel and Hamas. UN officials say heavy fighting between Israeli troops and Palestinian militants on the city's outskirts made aid crossings inaccessible and food and fuel supplies critically low. The lack of fuel now undermining medical facilities, water supplies, and sewage systems. The UN says the World Food Program will run out of food for distribution in southern Gaza by tomorrow unless they can get more aid in. Police have cleared a pro-Palestinian encampment on the campus of MIT. Quinn Perrion is a student at MIT and an organizer with MIT Jews for Ceasefire, and he says they'll continue to call on MIT to cut financial and research ties with Israel.
This is not in any way going to diminish the movement. We're stronger than ever. We've seen that MIT will do anything, even threaten the well-being of its own students, over divesting from this ongoing genocide.
Farian says he resents those calling for the support of the Palestinian people, anti-Semitism. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got stocks continuing to trade mixed as they have been for much of the day. The Dow, the S&P, they're both higher. NASDAQ in the red. We begin, though, with the S&P at 52.16, on track for a winning week, up 2 points. A little change now of less than 0.1%. The Dow up 69, up 0.2%. NASDAQ lower now by 20, a decline of 0.1%. 10-year at 4.50% with a 2-year 4.86%. Spot gold today, right now, we do have an ounce of the precious metal. It is trading higher. Gold up $22 the ounce, up 0.9%, 23.68. While West Texas Intermediate crude is down 1.1% right now, 78.34 per barrel of WTI. Novavax shares are surging after the company signed a $1.2 billion licensing agreement with Sanofi that includes commercializing a combined COVID-19 and flu shot. Right now, Novavax up by almost 100%. First day of trading for Zeekr, the high-end electric car brand under Geely Holding Group. They are pushing higher. Right now, we've got Zeekr at $22.17. Zeekr going out this morning at $26 a share, looking at an advance right now of 29.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, as we talked about earlier, our Bloomberg exclusive about President Biden getting ready to hit hard on China EVs with tariffs as soon as next week. That's according to folks familiar at the Wall Street Journal doing some reporting on this as well, saying those tariffs could quadruple. So it's one of our big stories certainly on this Friday.
Yeah, Bloomberg News reporting today that China is losing its luster as a top country to invest in as firms seek to avoid geopolitical risks and turn to Southeast Asia and Europe, according to a survey by the European Union Chamber of Commerce in China. So we thought we'd get a perspective from Ben Harburg. He's founder and portfolio manager at Core Values Alpha. He joins us where it is very early in the morning in Beijing. The Core Values Alpha Great China Growth ETF, it's got about $8 million in total assets. It's up to about 6% so far year to date.
Normal people would be asleep. I'm just going to put that out there, Ben. Anyway, we appreciate you getting up. It is hard to get your head and hands around, if you will, China being investable today, especially on a day like today where you've got a very successful Chinese EV maker IPOing here in the United States. And then you've got, of course, what seems to be more tariffs coming on that market, pushback on Chinese-made goods coming to the United States, if you will. So having said that, why is China investable in your view? Because it looks like, there isn't a lot of investor interest.
I think you have to separate the tariffs from the realities on the ground and the scale and growth of Chinese businesses and the demand of Chinese consumers. So if anything, the tariffs are the direct result of the success of Chinese companies. If I were the Biden administration, I'd also be looking to bolster American auto industry support, if that's domestic subsidies in the United States, or hitting hard on Chinese exports because they're falling behind. The Americans simply don't have that kind of vertical integration that the Chinese EVs and the kind of the case study that we're talking about have. And so the net result of all that is I think that actually belies a really strong Chinese market and a significant threat to incumbent interests across a lot of the key verticals. One would say that, for instance, a lot of the pushback against the likes of Tencent or TikTok is again driven by the success it's had against incumbents like Meta or Snap or others. So I wouldn't look too deeply into tariffs to explain the challenges facing the Chinese market, only that they might ultimately scare away some investors who see that type of headline risk.
Ben, is that the way that this is presented in Chinese media? Is it the way that you view it within China, that these tariffs and the reaction that lawmakers here in the U.S. have to TikTok parent ByteDance is the result of success of those companies?
I think they do. I think they perceive that. I mean, and there was leaked internal audio from the likes of Mark Zuckerberg, who was just simply stunned by the success of TikTok against his platform, and even tried to create a replica named Lasso that just absolutely got demolished by it. And we're going to see this across all verticals. It's not just electric vehicles. It's not just social media and short form video. The likes of Shein and Temu are penetrating deeply into American fast fashion brands, American online incumbents like Amazon, or even offline retailers like Dollar General. And so I think that necessitates action from the U.S. side to protect those incumbent industries. But it says nothing about the success of those Chinese businesses, which I think are doing very well in their own right. And China, as you know, builds companies that are built for that digital native population, that next generation of consumers. And that's why the likes of TikTok and Shein are doing so well against their American incumbents, which are more built for folks like us that went through this longer retail online evolution.
So Ben, talk to us about the Core Values Alpha Great China Growth ETF. It's got about $8 million in total assets. It's up about 6% year to date. So is the idea of the fund and the opportunity that you're betting on Chinese domestic growth and those Chinese companies that sell domestically, or is it the Chinese company that sells to the rest of the world?
So we do both. We see huge continued demand from the Chinese domestic consumer, and so we're investing in that kind of what we'd call kind of consumption downgrade and reshoring of domestic behavior. And so that includes domestic brands, so domestic cosmetics brands, domestic quick service restaurants, domestic FMCG brands, but also that includes domestic travel and other things that are benefiting from people staying home rather than going abroad. Then, of course, we invest in those cross-border players, both that are integrated on the hardware side, like the BYDs of the world, as well as those those that I mentioned previously, the likes of Temu and their parent company Pinduoduo, which is doing incredibly well.
Well, but tell me about your cap raise, your fundraising. $8 million in assets doesn't seem like a lot of money under management. So talk to me. We talked last time in February. What kind of flow are you getting in terms of assets? Because it does feel like investors are pretty tentative still.
So again, our background is on the private side where we manage over $2 billion. So certainly by our standards, this is a small AUM as well. I think it is largely driven by American sentiment towards China and particularly global sentiment of folks that would invest in ETFs. And I think we're starting to now see that our ETF, for one of the months of this year already beat the S&P. It's beating all the other kind of China ETFs since its launch as well. And so, but we've still got to see that kind of investor sentiment towards China. And I think that's less about geopolitics and more about returns. If I was an investor today, I would have kept my money closer to home because the NASDAQ and NYSE have been ripping. And there's no reason not to continue to do that because all the geopolitical noise is irrelevant if the returns are there. And so our belief is that as we're starting to see these markets bottoming and you finally saw a lot of that capital was flowing to Japan and elsewhere, finally coming back into China, coming back into Hong Kong, I think that rising tide will lift all boats. And then we really like our head-to-head chances against the other China ETFs because we're actively managed and we also try to filter out geopolitical risk or threats to American national security.
Hey, Ben, China, Carol just mentioned the idea that China, quote unquote, uninvestable. It's a question that we've been asking for a couple of years now, since a prominent bank brought it up a few years ago. And even at Milken this year, one of the panels, one of the panelists was asked, I think it was the CEO of Capital Group, was asked if China is uninvestable right now. What would you say to somebody who argues with you and says, you know what, given the geopolitical concerns, given the domestic concerns, given what's happening with the government there, I don't believe that China's investable. What would you say to that person?
The numbers would tell you that's not the case, right? So the numbers would tell you that China's growing at about double the pace of the United States. If you're interested in other emerging markets, let's say Southeast Asia, which you guys mentioned earlier on the program, China's in the process of urbanizing people from rural communities and second, third tier cities to the first tier cities. That urbanization alone will generate a customer base that's 2 times the size of Indonesia.
Ben, sorry, I want to jump in real quick because we only have 30 seconds left. Does that growth number even matter if the government can intervene at the drop of a hat?
The government had made changes over the last few years that were more to defend against what they believed were antitrust or other monopolistic actions by large Chinese technology companies. But overall, the Chinese government is still very much growth friendly and is now turned all of its attention on improving global investor confidence in its public markets.
All right, we're going to leave it there. Hey, listen, thanks so much. And again, thanks. We know it's wee hours there in China, so we appreciate you getting up for us. Ben Harburg, founder and portfolio manager at Core Values Alpha, joining us from Beijing. As we mentioned, the Core Values Alpha Great China Growth ETF, about $8 million in total assets. It's up about 6% so far here in 2024. All
right, well, speaking of things that are higher today, the Dow Jones Industrial Average higher by 0.3%. Let's say 100 points to the upside right now. S&P 500 up 0.1%. While the NASDAQ still down 0.1%.
It's been an uptrend in stocks this month. We'll have more on the momentum. Options Insight is coming up next, right here on Bloomberg Business Week.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English. but I decided to move to the U.S. with my family. Okay, let's study English. Let's, manage this big, American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Now, your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. McDonald's is looking to launch a $5 meal deal in the U.S. The burger chain is betting could lure penny-pinching consumers back in. A source says this deal could include a McChicken or McDouble, along with fries and a drink. On the company's first quarter earnings call, CEO Chris Kempczynski said McDonald's had to be laser-focused on affordability, given how price-weary diners have become. McDonald's up today by 2%. Sweetgreen shares are surging after the salad chain increased its annual sales projection and cited improving profitability as it seeks to expand its footprint. The company now anticipates same-store sales growth of as much as 6%, up from a prior expectation of 5% at most. Sweetgreen shares, they are surging today by 32.5%. We're keeping an eye on Zeekr Intelligent Technology Holding. That is the high-end electric car brand under Geely Holding Group. Those shares are pushing higher. Went out this morning at $26. Right now up by 27%. Shares of Zeekr, first day out, they are advancing. Elon Musk is touting plans to expand Tesla's supercharger network just a week after firing almost all of the roughly 500 people who ran the business. On X, the social network he owns, he said Tesla will spend over $500 million on its growing network this year. Ford has promoted Chief Financial Officer John Lawler to Vice Chair to oversee the automaker's long-term strategy, bolstering its executive ranks as the company works to staunch billions of dollars in losses in its electric vehicle unit. Ford shares today lower by 1%. Those are our top company stories, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stennebeck on Bloomberg Radio and Television.
All right, everybody, the S&P 500 heading toward its third straight week of gains, longest winning streak since February. Well, let's get more on today's trade. Options Insight with Bloomberg News Chief Markets Correspondent Abigail Doolittle, it's been a long week, Abigail Doolittle, and Spencer Hakimian of Tulu Capital Management joining us right now. Abigail, over to you.
Thanks so much, Carol. And we are actually going to take a look at gold, Spencer, instead of the S&P 500. And speaking of a rally, since the October lows of last year, up more than 30%, do you think that it can continue?
Look, right now we're living in a world where there are sovereign and non-sovereign state actors shooting missiles at one another. Core inflation in the U.S. has gotten sticky somewhere between 3% and 4%. And just last week, the G7 had announced that they're considering freezing and potentially even selling Russian dollar and euro reserve assets. So in terms of bull cases for gold, I think they're plentiful. In light of that, we bought a June 2025 call option for gold at a strike price of $27.50, which is currently about 15% out of the money. And let's just say that that rally were to continue, and let's say we get to 2,500 by Labor Day. That's about 5% above the spot price. That option we just spoke about would be up 80% from our basis. So could the rally continue? We think it could, and if it does, we would rather express that via an option rather than buying the spot price, because we think if it were to continue, it would happen quickly rather than,
Yeah, well, it's interesting because just taking a look at the technicals on gold, I mean, this rally has really been pretty incredible, and it appears as though maybe there could be some consolidation, or on the other hand, if we make it past the last high, which I think was 24.31, it looks like it could shoot up to your level like almost immediately, which is pretty incredible. A lot of people talking about the factors you're talking about, but then on the other hand, if the Fed were to cut, then you would almost have that dovish element. So gold sort of in the sweet spot. Are there any other ways to express your views in gold?
Yeah, I'll just take it back for 1 second briefly. Is this trade a guarantee? No, of course it's not. Nothing in capital markets is a guarantee. But because there is that scenario where we could have an inflationary risk-off event where treasuries might not be the perfect hedge, we just believe that it's worth putting on, 2, 3, 4% of a book of risk onto a trade like that, because if it were to work, it would be outsized, and if it was not to work, a 2, 3, 4% loss is very manageable and should hopefully be, the rest of the book should hopefully go up to offset that loss. But yeah, if you just want to, you could also just outright own spot price of gold, which is not the worst thing, because it's obviously, it's obviously less upside, but if it won't expire worthless, options do expire worthless if they're out of the money. So we think you can also just buy it straight up if you want to too.
Well, it sounds like options, your option trade is a good way for a hedge. It sounds that's how you're playing it, and that dollar chart in a range, hard to understand. It's going to be very interesting to see what happens next with gold. Spencer Haikimian of Tulu Capital, thanks so much for joining us for Options Insight today. And Carol, Tim, back to you.
All right, great stuff. Abigail Doolittle, thank you so much. All right, folks, that's going to do it for our first hour of Bloomberg Business Week. Hey, coming up next, if you're going to stay with television, the close is coming your way, so be sure to check that out. If you're staying with us on radio, YouTube, and Bloomberg Originals, Bloomberg Business Week continuing, we're going to talk a little bit about wind farms in New Jersey. We're going to talk about the Super Bowl of the flower industry. And one of our most read stories on the Bloomberg has to do with something that happened at Milken.
Yeah, that's all I'm going to give away right now, but this is the most
It's a name you'll know.
Story.
It's a name you'll know.
It's a name you'll know. A name you'll know well from over the last few months. And a really important story, too, by our own Simone Foxman. So we look forward to her joining us as well.
And a new work of fiction on what if Russia had chosen a different path forward. We're going to get into that. A fascinating new book by a New York Times bestselling author. All to come in the next 2 hours of Bloomberg Business Week. I'm Carol Massar, along with Tim Stanovic, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Consumer confidence wavers, and so too does the stock market. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Welcome back, by the way.
Thank you. Good to be back.
You jet lagged? You all right?
No, I just thought I'd come back to some warmth here, but apparently, Alex, you got to do something about the weather.
No, we don't do that. Weather weird. It was like 90 degrees on Wednesday. All right, let's get checking here on where markets stand. The S&P 500 is up by about 0.1%. That's the good news. However, we were up a lot more before we got that UMISH data that crossed at 10. We'll get to that in just a moment. Speaking of, the two-year yield, seeing some selling. You're seeing a move higher, about 5 basis points in the front end, again, along with that UMISH data. Copper, though, quite interesting, above $10,000 a ton, and it raises the question, really, are we in another sort of weird market where things don't make sense? Again, we'll talk about that. I know you hate this. I know everyone hates this, but the Dow Jones, I just want to point that out because we're very close to that nice round 40,000 number. It's rising 8 straight days, Romaine. That's the best streak that we've seen since December of 2023.
Well, hopefully I still have time to print out my Dow 40,000 hats, Alex Seal. I'm still sitting on those 35,000 hats, and nobody wanted to celebrate. But that strong start to the week that we had for U.S. equities, that has flatlined a bit here at week's end. Now, it's really kind of a confluence of concerns around weakening economic data. It's kind of so-so corporate earnings, and more Fed members really really talking about this idea that cutting rates in 2024, even once, may now be out of the question. Fed Governor Michelle Bowman, the latest to posit that scenario, telling Bloomberg in an interview that her base case remains higher for longer. And that really does dovetail with a lot of other comments we've gotten this week from Dallas Fed President Lori Logan, Boston President Susan Collins, and Minneapolis Chief Neil Kashkari, who I had a chance to catch up with at the Milken Conference out in L.A. a couple days ago.
We're committed to 2%. We will get to 2%, and we will get an interest rate environment necessary in order to achieve 2%. The second half of 2023 surprised us at how rapidly inflation fell. It seems like it stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time.
And those comments coming just as earnings season starts to enter its final few days. And it really is an earnings season that's similar to Fed speak, has pivoted as well from consistent beats to a hodgepodge of disappointment, at least when you exclude the Magnificent Seven. Earnings for S&P 500 companies now down about 2% from a year earlier when you back out those 7 tech behemoths. At least that's according to the data put out by JP Morgan strategists, and that would mark the 5th straight quarter of profit decline on that basis. Now, investors have to digest another pivot, and this time in the economic data, which went from strength at the start of the year to Goldilocks a couple of months ago to uh-oh today. A U.S. consumer sentiment reading declining in early May to a 6-month low. And the real thing, Alex, that jumped out at me were those inflation expectations, at least in the short term, now starting to rise.
Yeah, we spoke to Joanne Shu on radio. She kind of leads the data, and she was saying that also consumers are worried about higher interest rates. Yeah. Not just a cut, but higher interest rates. And this is where I think it's interesting when you pair it with the equity market. So the orange line is the University of Michigan sentiment, and the blue line is the Russell 2000. The white line is the S&P. So as we can see here, before the pandemic, you can make an argument they tracked each other fairly nicely. You saw a decline in sentiment, and stocks took a little dip. Decline in sentiment, and stocks took a little dip. Obviously, we've seen a big divergence. Maybe those are the pandemic checks. You can make an argument. But nonetheless, the idea is when you have a dip, equity markets do dip. Had a dip back at the end of last year. Equity markets also dip. So what happens now? So we're near record highs for the S&P. We're stone's throw away, near record highs for the Russell 2000. So if we really see another decline here in the University of Michigan, will that eventually pull down equities, Romaine?
It'll be interesting to see. I think that really is the big question that everyone has. So let's pose that to our first guest. Kicking us off to the close here on this Friday afternoon is Mark Pinto, head of America's Equities at Janus Henderson Investors. And Mark, I mean, we talk about a stock market, I should say, kind of inching back towards those record highs. And that's in the face of all those rate hikes, that we got last year. Now sitting at 5.5%, at least on the top line. And investors now coming to terms with the fact that we're not going to get any rate cuts, at least not anytime soon. Why am I to believe, though, that that's going to be bad for the stock market?
Well, thanks, Romaine. Thanks for having me on. It's great to be here. So I think the first thing to note is that while there are periods when the market and interest rates are negatively correlated, in other words, when rates go down, the market goes up, that's not always been the case. So we can point to plenty of times in market cycles where the market has continued to go up in a flat or rising interest rate environment. And I think the reason for that is we're seeing, a lot of innovation, a lot of secular trends driving companies and sectors higher. And those trends are happening regardless of the interest rate environment, whether it's technology or healthcare or even in areas of consumer innovation. These forces are driving industries and sectors higher. Companies have got strong balance sheets and they're benefiting from that. So, we do think that, whereas we do think that rates will ultimately come down, we don't think that the market's going to be on hold until we get to that period.
Talk about some of those bigger themes. Obviously, AI was a big driver of market gains last year. You mentioned a couple others, including healthcare. What are you seeing there that is big, that is structural, that is thematic?
Well, in healthcare, we're really in a golden era of innovation and new drug formulation. I think last year the FDA approved 70 plus compounds, which was, I think, a record. And so clearly the R&D efforts of the large cap pharmaceutical companies, of biotech companies, are yielding much more positive results than they have in the past. I think AI is a part of that, and the fact that they're using technology to help them, figure out which compounds are going to be the winners and which are going to be the losers. And what we're seeing is that not only are we seeing new drug discovery, but these drugs are actually meeting unmet medical needs. And so whereas in the past, a lot of the new drug discovery was just another drug to treat cholesterol or high blood pressure, now we're seeing real breakthrough therapies that are meeting unmet medical needs. And there's probably no better example today than the GLP-1 inhibitors, or otherwise known as the weight loss drugs, that are having real effects not only on obesity but on all other corresponding diseases and symptoms that are part of obesity.
I also wonder too, in terms of a structural shift in the economy, what do you make of utilities? Because the second best performing sector in the S&P this year are utilities, after communication services, which, let's be honest, is just technology. How do you understand that? Like, you could make an argument that's a defensive play, or is that actually a growth AI data center play, which, to your point, in terms of structural changes, is definitely a big one?
Yeah, so I think, look, utilities have typically been tied to economic growth. So, when we have looked at utilities at Janus Henderson, we typically look in regions where there's population growth, where there's industrial growth, and so there's essentially greater demand for electricity. But I think you're right. I think what is happening in terms of just the upward movement in the whole utility sector is people are realizing that these data centers are going to be incredibly power consumptive. But by the way, they're also going to be consuming a lot of water, which is something I don't think people have focused on. But the fact that we're going to need to generate so much power and electricity to basically power these data centers is what I think is one of the reasons utility stocks are going up.
Which then brings us back to the beginning of the conversation and sort of the soft indicators, ISM services, NFIB, the UMISH sentiment, they all go lower. Stock market can go higher because you're seeing these structural shifts regardless of any cyclicality. Is that a fair statement?
I think that is part of it, and talk about like the consumer and the fact that consumer sentiment has been a little bit weaker of late. When the consumer is cutting back, they're not cutting back on all parts of their spending, and we've seen a trend, for example, where consumers are definitely cutting back on buying material goods. They're trading down when they have the opportunity, but they're spending more in areas like leisure and travel, basically favoring experiential spending over buying material goods. So I think that just speaks to the role of active management and being able to pick subsectors within an area that might on the surface look broadly weak, but where there are definitely pockets of strength and increased spending.
All right, Mark, always great to talk to you. Mark Pinto there, head of America's Equities over at Janus Henderson Investors, helping us kick you off to the close here on this Friday afternoon. Coming up, a closer look at shares of Sweetgreen, having one of their best days since their IPO a few years ago. This after the salad chain boosted its outlook. A conversation coming up in just a second here with Nick Newman, of course, the CEO over there.
All right, plus another big mover, Novavax, surging the most in 15 years on a new licensing deal. That details in today's Stock of the Hour.
And EV maker Zeekr going public in the biggest Chinese IPO here in the U.S. since 2021. We'll have the latest on that and so much more right here on The Close on Bloomberg.
This is Bloomberg.
Morning from our world headquarters in New York. I'm Manus Krenny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Season is here.
This is a get out the popcorn moment.
An across the board just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey folks, we've got Microsoft.
Apple earnings crossing the wire.
Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
And lots still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
Shares of sweet green surging today. That feels like an even understatement. At one point up like 50%. The salad chain boosting its full-year outlook with big plans for expansion. A big part of that strategy is steak. The company introducing the new menu offering just this week. Our own Scarlett Fu sat down with the CEO, Jonathan Neiman, to discuss all of that and more.
There's a lot of energy around protein as a healthier way to eat, which we totally agree with. And so this was a perfect time for us to introduce this item to really also expand the customer base as we look to open stores all around the country, in Texas, in the Midwest, in Florida, and Atlanta. Steak is something that those customers really, really want. And so as we move from the coast to the rest of the country, that's been another catalyst for us.
Sweet green is definitely something that vegetarians love and women in particular love. What does your customer base look like now, and what do you expect it to look like once beef really is something that your customers get accustomed to?
So as you'd expect, Sweet Green's customer base does lean more towards women than men, and we see a huge opportunity in winning more of that male business and really getting rid of that no factor, where oftentimes you see a couple will come and the woman will come to Sweet Green and the man may go somewhere else. And with the introduction of protein plates and now with steak, we're seeing heavy adoption, really from all customers, but even more so, it's indexing heavier with men. So over time, I see a world where both lunch and dinner get to more of a 50-50 split, as well as male and female are more 50-50. So that's kind of where we see the business going over time.
Let's talk about that automation technology. It's called Infinite Kitchen. You have 2 restaurants using it, and you'll be opening 7 more with the system this year. Analysts and investors love it, in particular the fatter margins that come with those locations. What's been the feedback from your staff? What's been the feedback from your customers?
Absolutely. So one of the frameworks we use to make decisions is what I call a win-win-win. Finding a win for our customers, our team members, and our business. And the Infinite Kitchen does exactly that. Our customers love it because the speed of service is significantly faster. The technology can deliver 500 bowls per hour. The accuracy is perfect. So, and just the food quality that comes out of it is phenomenal. Our team members love it because it's a lot easier to work in that environment. So we've seen significantly less turnover in those restaurants. And then lastly, from a business perspective, we've seen a really nice margin expansion with that. Again, it's very early. There's only 2 restaurants. One of them's been open exactly a year. The other's just been open a few months. And this year we're going to learn a lot more as we do a few retrofits and open a few more. We're going to learn a lot more. We're going to continue to evolve that customer experience, and we're going to continue to iterate on this. But over time, we think that the Infinite Kitchen can play a huge part in our success.
So, Jonathan, are there certain locations where implementing Infinite Kitchen is a priority? For instance, like in California, which of course has passed this minimum wage law that increases wages to $20 an hour.
So we look at Infinite Kitchen as it relates to where we have higher volume locations. We really, as we think about the capital allocation and making sure we hit our return targets. So this year we will be testing, as we mentioned, a few urban retrofits. So actually taking a few stores in New York that have very high volume and renovating them with the Infinite Kitchen. And we'll also be opening the Infinite Kitchen in about 7 new restaurants. And it'll be a mix of restaurants. Some will be in California, but many will be really all around the country. And we don't think this is just meant for places like California. Of course, there's more leverage when the wages are higher, but we just think it's going to be a better experience overall.
So in California, you raised your prices in that state by 5% in February in anticipation of the increased wages to offset that increase. What did you observe when it came to the impact on sales? Was there any kind of initial dip and then a recovery? How did that play out?
We saw no change in traffic via the price increase. I think one of the things where we were benefited from is our price increase in California was less than most of our competitors. We were already paying almost $20 in California, so we had to take a much smaller amount of price increase in order to pay for it. So overall, not seeing a lot of price sensitivity, especially on a relative basis, as food has gotten more expensive, especially if you think about QSR and fast casual. They've seen about 30% price increases since before COVID. And so on a relative basis, I think Sweetgreen's delivering a lot of value that our customers appreciate.
All right, Nick Neiman there, the CEO over at Sweetgreen. And it's really interesting in these results because this was a company that kind of been sliding back in terms of revenue growth. Not only did they come out with new products, but they raised their prices as well, which is a big part of the reason for the revenue beat. But I was kind of interested that he seems to think that this pivot to steak and maybe some other options will bring, I guess, more people into the door, particularly men, as he said.
Are you a Sweetgreener?
I used to be. Prior to the pandemic, as you know, we have a Sweetgreen near the Bloomberg World headquarters. Went there all the time, almost every day. And then, I don't know, I just stopped going. And then when they reopened in the middle of the pandemic, I noticed the prices were a lot higher. And you're kind of like, do I really want to spend $18 for a salad? And the answer was frequently no.
I'm totally with you on that. I mean, the funny thing is that you can make an argument that a 50% increase at one point in the stock, that's also some short covering, right?
Yeah.
But if you talk about the broader, like Starbucks, McDonald's, they're all warning about the consumer. And then you have Sweetgreen's able to pass on those prices and increase their revenue. What is that?
Right, but what's the cap, though, right? I mean, obviously, to a certain extent, they're dealing with a different consumer that probably has maybe more means, let's just say. But isn't there a limit to that? I mean, you and I talk about this internally in the office. A lot of people in the office talk about it. Like, where are we going to go for lunch? Do we want to go down the street and pay $18 for a salad, or maybe go somewhere else and pay, well, I don't know, still probably like $18 for a sandwich?
But,
the options in Midtown Manhattan are not.
I take the escalator upstairs, and I get the food that's in the Bloomberg right there. Save that money.
All right, the Mike Bloomberg special there. Speaking of food, coming up, we're going to talk about Cheesecake Factory. I haven't been to one of those in a while, but the folks over at Citi, they're developing a bit of a sweet tooth for the company, a bullish outlook for the restaurant chain. We're going to talk about that. It's part of our top calls coming up in just a second, right here on The Close on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
All right, let's get a view from the sell side with our top calls, the big movers on the back of